All right, how's it going, everybody? My name is Antonio. I am still an aspiring grill master, and I have a wonderful barbecue here for you today. Three companies. We're looking for graphite in Canada, we're looking for silver in Mexico, and we're looking for gold in Ghana, one of my favorite places actually in the world to be looking for gold, West Africa. So you hear more about that here in a second. But I also have some bad news because apparently now I have to become one of the folks on YouTube who beg for subscribers and likes and all that. And although we have plenty of subscribers, apparently not all of you who watch these videos are subscribed. So you should obviously, first of all, subscribe. And for the ones of you who are subscribed, apparently not all of you have clicked the little bell thing next to the subscribe button. When you do that, you're going to get notified when we publish a new video. And so, again, apparently not all of you have done it. Apparently not all of you have allowed notifications on your phone. And that's obviously completely unacceptable because obviously you never want to miss a chance to look at my face 2 or 3 times a week for 30+ hours each time. Or so does my mom tell me. I wish my wife would also tell me the same thing. But anyways, turn on notifications and be notified each time I publish something, because even though I am a ginger, despite popular belief, we do have souls, and I have an ego too, apparently, and my ego would appreciate it very much if I were popular. Okay, so now that we all have barfed, I can jump into my favorite part of the CEO barbecue here, which is the disclaimer. That's there's one on your screen right now that I not only want you to read, you're apparently obligated to read these things, but you're also advised to do so because it's not just some disclaimer. It's an actual warning that will help you not lose money or prevent you from making big mistakes and not listening to. Anyways, you'll see when you read it. And although I am here to make money, it is no secret that here at Resource Talks, we try to be different than other channels by not hating the viewer. Fortunately, that's a rarity these days. And what that means specifically is that I would like you to be aware of the fact that 2 out of the 3 companies that you will see here today have paid for the production of their interviews. Specifically, Newcore, Goldcorp, and Kootenay Silver are paying clients of Resource Talks. They're paying for the production and publication of these interviews. But even the ones, or well, one in this case that isn't paying is still likely seeing their participation in this program as a chance to do some marketing. So start by understanding that, but also be aware that this and other channels who interview CEOs, we typically earn our money by charging for the creation and publication of these interviews. And so, although I don't make any buy or sell recommendations on this channel because there's a clear conflict of interest, many still do. And you should be aware of that inherent bias, which isn't always clearly disclosed. And just anytime you're watching anything that has to do with public companies, any type of company specific content, just approach it with a healthy dose of skepticism, use your own brain, make your own decisions, and just treat it as marketing. Even my interviews, although again, we try to be different than other interview providers by looking more into more stuff than just the front page of the company's website. And unlike most, we don't give the companies the questions up front. There are no questions off the table. And the companies get no say in what ends up in the final video product. So these things should still be looked at as advertisements, even though that's the case, and not as research, and definitely not as recommendations. There are no guarantees here besides that there will be forward-looking statements in these conversations, and those are conversations that are general and impersonal in nature. They're going to be containing hopes and dreams for the future, for events that may or may not take place, depending on many different things, both within and outside of the company's control. So be aware of that, and please talk to a professional investment advisor. Please do more research before taking any decisions in the end, taking your own decisions in the end, of course. And go to setterplus.ca, where you're going to find the official government filings of those companies. There are disclaimers on your screen right now. As I said, this is probably the second one you're reading. If you don't enjoy losing money, you have to read them and be careful out there. But all that said, though, I am going to go into the first CEO barbecue for this year, for this week. Wow, for this year. No, probably like the 150th or something like that. But for this week, it is the first one, which I'll be traveling to one of my favorite places to go looking for gold, with that being West Africa, Ghana specifically, where I'll be getting an update on a growing PEA stage gold project, and hearing about it from Luke Alexander, the CEO of Newcore Gold. Company is listed as NCG. AU on the Ventures Exchange in Canada, where an average of about 260,000 shares trade each day, with a 52-week high of 39 cents and a 52-week low of 9 cents. With a market cap of about $55 million and about 185 million shares outstanding, today this is a 30-cent stock. There were, I should better say, 6 million warrants and 11 million options, leaving the number of fully diluted shares at just over 200 million. But as I'm alluding to, that might be different now because there has been recent exercising of warrants, which I'll touch upon here in a second as well. There's a rather large, over 20% insider ownership here, and there's also a very strong institutional backing where almost half of the company is actually in the hands of various institutions, from Franklin Templeton to Mark to Ruffer and so on and so forth, leaving only about a third really of the company that's in retail hands. The last financial statement, which is dated March 31st, shows me $3 million in current assets, most of which at the time, $2.6 million specifically, was in actual cash. There was some prepaid expenses and some tax receivables on top of that. And again, this is going to be different now because one, of course, there's an ongoing spend. This is an exploration company that's a living and breathing thing, but also because there's been warrants exercising, as I mentioned, resulting in about $3.2 million being added to the treasury. There's no long-term debt with the company, and there is very little current liabilities in the form of $270,000 worth of account payables. That same financial statement from March also tells me that on average, over the last reported 3 months, Newcore recorded about $145,000 a month in administrative expenses. That's excluding share-based compensation, with management and marketing making up the majority of the spend here. Making the administration to exploration ratio here will not make too much sense right now because although the company was not actively drilling over that 3-month period, they are going to be drilling now. And that's also what Luke and I will be talking about later on. But as always, please understand that this financial statement I'm going through is nothing more than a snapshot in time. In this case, it is specifically at the end of March of this year. And so this really only covers 3 months of time, which might not always be representative of everything, given that exploration seasons differ. There's warrants exercising. And again, as I mentioned, these companies are living and breathing things. So please go to the company's own website as well as setterplus.ca, both of which are going to be linked somewhere below, and look at all the numbers yourself to make sure you're getting the full picture. Talking about full pictures, I'm not painting a too in-depth picture here today, either, because I, as I alluded to at the beginning, this is not the first time Luke and I are speaking. We did a pretty in-depth interview about a month or so ago, and I will direct everyone listening to that video for a better company overview. You can go to watch that video. But in a nutshell, Newcore owns the Enchi gold project in Ghana. This is one of the best gold jurisdictions in the world, as I alluded earlier. For many reasons that we might get into later on. But this is, they have a PEA stage asset here showcasing a low capex open pit heap leach project, which when looked at through the lens of $1,850 gold price carries a $370 million after-tax NPV 5. And again, this is gold price that is, at this point, probably over 30% lower than what the current gold price is. But then even at that price, there's a 58% after-tax IRR with a just over $105 million capex paid back in only 1.5 years of operations. But that's also not the only thing making this project worthwhile. The company believes there's a whole lot more upside to that resource, considering that the project covers almost 250 square kilometers of land in total, only about 10% of which has actually been drilled. And there are several multi-million ounce operating mines in the region, and which is also why they've just started a 10,000 meter drill program, which is also the main reason why you're here today, Luke. So first of all, thank you for taking the time to talk to me. And you actually just came back from Ghana, as I understand it.
Yeah, thanks for having me on, Antonio. Yeah, I was in Ghana, I guess it was about 2 weeks ago, for about 10 days, just visiting the project and catching up with various government officials on the back of the PEA that we outlined and put out to the market.
Who are you catching up with? What are you guys talking about?
Obviously, catching up with the team on the ground in country. And then obviously, there's lots of stakeholders around the project. So meeting with those various stakeholders, and then meeting with some government officials. So, going to the Minerals Commission, meeting with the CEO there, running through our project. And, one of the things that really stands out for us at Newcore is how supportive the government is in Ghana to see this project, through to production. So one of the things we're actually going to look at doing is applying for a mining lease. We expect we'll be able to get that completed within about a year. So the technical work that's been completed within the PEA, along with a updated social and environmental baseline study that we released, or that we got completed in 2023. That's the work that's required to apply for a mining lease. When we went and met with the Minerals Commission a couple weeks ago, they've given us their full support to apply for that mining lease. So it's one of the things, again, you talk about Ghana being a great jurisdiction, and this would be a really good example of this, where ultimately being able to get projects permitted and then into production is a real differentiator. If you look at the country as a whole, they've got about 800,000 ounces of additional production coming on stream in the next few years. You've got Shandong's Cardinal, the Cardinal asset, Namdini, which Shandong bought. They're going to be commissioning that in November, which will bring about 370,000 ounces of production on stream. You've then got Newmont, who's expanding the Ahafo North project. That'll bring about another 325,000 ounces on stream. So just between those two projects, you're looking at almost an additional 700,000 ounces of production. There's then a private company bringing their asset into production, which will be about another 150. And then, the Minerals Commission sees how our Enchi project will, slide in right behind those three projects, and hence the reason they're very excited to see us applying for a mining lease.
I also never really thought of the mining lease or any of the government permitting as a risk there, because as far as I understand it, when I say that Ghana is a great jurisdiction, it's not just my opinion. I believe that's Africa's main gold producer, or something among those lines, right?
Yeah, so Ghana is Africa's largest gold producer, so it produces about 5 million ounces per year. You've got three of the top 10 largest gold producers with significant operations there. So Newmont has a significant operation there. They're putting another $1 billion into Ahafo. That will make their Ahafo project their second largest producing mine, just after the Nevada Gold Complex. You've got Anglo Gold and Gold Fields, who also have significant operations in country. Shandong, as I just mentioned, they're bringing 370,000 ounces on stream with their Namdini project. So you've got a lot of major mining companies in country. And again, I think that's another way of looking at what a great jurisdiction it is, the fact that you have these major companies. I mean, I'd encourage you and any of your viewers, when you're doing your research on mining jurisdictions, one good way to start that research is who's actually operating in country. And, for us, I think, the fact that you've got these major mining companies there highlights, from a security perspective, what a great jurisdiction, but also from a mining law perspective, and stability perspective, why Ghana is a great place to be operating.
I think there was also, maybe not necessarily related to you, but related to mining. Definitely, there was a bauxite, iron ore mineral permit, kind of a big deal, but granted in Ghana. It even crossed my desk, so it must mean it's a big deal.
Yeah, I mean, that operation that you're talking about has been in production for over 100 years now, and they're actually in the process of building a smelter in country. So that's over a $400 million investment to build that smelter. So again, Ghana is looking to vertically integrate, some of their industries, and that smelter is an example of that.
Right. You have a couple of steps to complete before going into production, though, and you're doing one of those. Probably part of your visit to Ghana was to plan that 10,000 meter drill program that you have going on right now. Yeah, talk to me about. Give me the summary. I know it's mostly infill, but what are you doing? What are you drilling?
Yeah, so we announced a fully funded 10,000 meter drill program. So that's on the back of a bunch of proceeds coming in from the exercising of warrants that expire on June 28th. With that money, we're going to focus on resource expansion as well as infill drilling. So a lot of it will be focused on our two largest resource areas, Boyne and Seum. Those resource areas feed about 80% of the ounces that go into our PEA. We'll then also look at allocating a portion of the meters to continuing to step out and make new discoveries on our project. So the drilling will be RC drilling. So we drill for about $100 a meter all in. So obviously, with the roughly 5 million Canadian of cash that we have today, we're fully covered for that drill program and excited to be getting the rigs turning again.
I do want to talk about money here in a second too. But what about what's the split going to be in here? As I mentioned, it's mostly infill, but what percentage is going to be infill versus step out or exploration drilling?
So we're working through some of that at the moment, but roughly 80-20 is the split that we're looking at.
Right. And that 80% that is going to be infill, is that a 50-50 split between Sewum and Boyne, the different targets, or how are you going to split that infill?
It'll be slightly weighted towards the Boyne deposit. We're just finalizing some of those plans at the moment, but yeah, slightly weighted towards Boyne is what it's looking like at the moment.
But still nothing at to the north at Nyam or Kwachi Krum or anything else to the north?
Yeah, with the initial 10,000 meters, we're not going to focus on drilling up at Nyam or Quachikrum. I mean, that's one of the nice things we have with our project is, I mean, we've identified over 25 targets to date across the project, of which we've drilled on 9 of them, and 5 of them make up our existing resource. All of our deposits remain open along strike. We've identified parallel structures at a number of our resource areas. So for us, it's really, ultimately prioritizing where we drill. And with a 10,000 meter program, our view is focusing on our 2 largest resource areas, which again remain open along strike and at depth. Makes the most sense. Partly because it fulfills a couple of things. One is obviously we need to convert a certain amount of ounces to feed the PFS. Boyne and Seum represent 80% of the total resource that will go into that PFS. So focusing there makes a lot of sense. But then the fact that we've got a number of target areas that we can also look to expand resource at both Boyne and Seum, given the rig's going to be already there, it makes a lot of sense to stay concentrated on those areas.
You did mention the initial 10,000 meters, which kind of made me think, because they're going to be anything more this year, and what does it depend on that you drill more or not?
Yeah, I mean, our view is, now that we're going to get back drilling, is to just continue drilling. So, we'll get focused on this 10,000 meters, and then as results are coming out, we're constantly reevaluating what makes the most sense in terms of potential expanded drill programs, so on and so forth. So, but the real focus for now, for the next couple of months, is on the 10,000 meters of drilling.
Okay. And to go back to Selm and Boyne, they're open everywhere, basically along strike and at depth. Where do you go chasing this? And how yeah, where the hole is actually going to be?
Yeah, so the focus for the drilling, and one of the nice things is, a lot of if you look at our resource today, the pits that constrain our resource today are down to an average of, about 75 meters. So we can drill a lot of kind of 50 to 150 meter holes to obviously convert ounces, but then also make new discoveries. So that'll be the focus, is really RC drilling on that first kind of 50 to 150 meters, and really look at growing those near surface, easy to mine ounces.
Growing bowing. I like it. I like when it rhymes, it makes sense. RC is but average depth, you're 50 to 100, so average 100, or is that kind of how it's going to
Yeah,
work?
I mean, again, if you look at the average vertical depth of the pits that constrain our resource, it's down to about 75 meters. So in that kind of 50 to 100 meter range is where we'll focus a lot of that drilling and resource targeting.
But then eventually, I assume you do want to do some core drilling and get into the sulfides potentially.
Yeah, I mean, if you look at our kind of project, and again, we're spoiled for exploration opportunities. If you look at some of the discoveries we've made at depth, we've put a few dozen holes in deeper on the project, and for us, deeper is down to kind of 250 to 350 meters. Our resource update that we put out in 2023 actually had an underground resource of 136,000 ounces. That came from 3 different areas, which again is not a mine today at 336,000 ounces. But what it is for us is it's a proof of concept. It shows that, we've got some of these high grade feeder zones that we see at other deposits along the Sefwi-Bibiani belt from us, including, Chirano, Bibiani, the Ahafo mine, which Newmont owns, which we've talked a little bit about. So we will get back in there at some stage to, target some of those high grade feeder zones. But for us and for our major institutional investors, we see the opportunity to fast track this project into production. And given the economics that we outlined within the PEA and the after tax cash flow that's generated, we see infilling and resource expansion near surface as the best way to create value for shareholders at this stage. But we've always got that lever we can pull at any point in time to go and do some, deeper diamond drill holes as well. So that optionality is something that us as a management team and shareholders of Newcore, we really like.
You mentioned that you're kind of spoiled for drilling opportunities there, and that's not a lie, because when I opened the map, all these green squares basically that you have on the map on here, those are basically targets that you found mineralization at. So all of this is to be followed up, and it's a lot. I mean, there's how many is it? It's more than 20 or something. I mean,
Yeah, we've identified more than 25 targets across the project, and I think what you're probably referring to there is the airborne geophysics that we've run across the property. So, very simplistically, what you've got is you've got the Bibiani shear, so a shear zone that runs north-south, up and down the Sefwi-Bibiani belt, which is one of the 2 prolific belts in Ghana. Where the mineralization sits for us, as well as other deposits along the Sefwi-Bibiani belt and along this shear, is you get these second and third order splays that come off of that main shear. So when you look at, the airborne geophysics, you'll see these big, red and pink, sections going through our project. So those are the second and third order splays that are running through our project that are highlighted in the airborne geophysics. If you add up the strike length of all of those shears, you're looking at about 100 kilometers of strike length. We've then gone and done tens of thousands of soil samples across our project, which again, you can see that in our presentation, or if you go to our website and get into our 3D model, you can turn all these layers on and off and look at that. But when you look at those second and third order splays and then line them up with all the soil sample work that we've done, you can see the huge district scale opportunity that sits at our project. So over 25 targets identified to date. Again, we've only drilled on 9 of them, and 5 of them make up our current resource. So that's the district scale opportunity that we've got at our Inchy project.
What I was wondering about these 25 targets is, given that they all look prospective, based on all these things, and there's also structures in the region too, that they are typically along those structures, kind of to the east from the Bibiani Shear. But how do you prioritize? Like when you say you only do 20%, roughly 20% of that 10,000 meters that you're going to be doing, so that's 2,000 meters of drilling. Yeah, how do you prioritize where that 2,000 meters of drilling goes on those 25 targets?
I mean, we've got the good fortune of having done a bunch of exploration drilling already. So we've identified areas that we see as very prospective based on some of the initial drilling that we've done at those areas. So we haven't done enough drilling to be able to wrap a resource around it, but based on the initial kind of holes that have been drilled, those areas will warrant follow-up drilling. So that is one, one way is obviously where we've drilled, had good results. We want to go back there, step out, continue to grow, and look to ultimately over time wrap a resource around those areas. In terms of, initial work that we do. So again, you start with the airborne geophysics, we then do soil sampling, and then after soil sampling, typically what we'll do is we'll go and dig trenches. We'll take samples from those trenches. We then obviously get those tested for for what kind of gold mineralization is within those trenches, and then based on what those results are from the test work that we've done, we'll then ultimately, decide whether to go in and drill those areas or not. So, those are a few of the things that we ultimately use to identify areas that we want to drill and that we see as prospective.
Where has that brought you now? Because again, you mentioned that you want to do multiple targets. I saw a mention of Amampe in that news release. Where is that 20% going to go into specifically on these targets?
Yeah, so Omampe, specifically, when you're looking at the map of our project, you'll see a license to the east, so to the right on that map. That's an area that we recently staked. So it's about 32 square kilometer land package. You'll see if you look at the airborne geophysics that some of the structures run right through that area. So that's an area where we're at the moment doing some soil sample and trench work and starting to look to identify targets within that Omampe area that we'll want to ultimately drill in the future. In terms of the drilling that we have planned as part of this 10,000 meter, there's some parallel structures at Sium specifically that we've had some very good initial results from that we'll look to go and do some follow-up drilling on, as well as again at Boeing, continuing to step out and chase these structures is something we want to do. I mean, if you look at the anomaly at Boeing, it's about a 15-kilometer long anomaly, of which our resource currently sits on about 5 kilometers of that 15 kilometers. So needless to say, there's plenty of room to continue to chase that structure. So those would be a couple of the areas that we're looking to continue to prioritize.
That's chasing it north, basically up the Boyne shear zone.
Yeah, so for Boeing, it's more chasing it to the south than to the north at this stage.
Okay, good. Is there any other reason in terms of lithologies or something that you see like it's the same rock and that's why we're chasing it more to the south, or like what's anything else?
No, it's more just again based on the airborne geophysics and the orientation of the structure, and then obviously the soil sample trench work that we've done, and then just systematically stepping out and continuing to drill. there's also an element that, once you've put a drill road in, being able to just continue to extend also helps from a cost perspective and from an efficiency perspective. There are areas within our property that, maybe we need to build a 2 or 3 kilometer road to get into. That inevitably then becomes more costly from costly from an overall drilling perspective. So all of those different elements go into how we prioritize targets on our property.
Yeah. Yeah, that makes sense. Clear strategy too. So I appreciate you explaining it that way. What's the not necessarily related, but I have it on here that I wanted to ask it. What's the for the infill work, how much spacing are you having to use?
So typically 50 meters along the section, and then 20, drill density of 25 meters is what's required to get to that indicated category. So what will typically happen is, we've got these structures that'll be running, vertically on an angle, and we'll drill, and then we step back another 25 meters, step back another 25 meters, another 25 meters. So you're essentially drilling this thing all the way down, and then that spacing into that structure ultimately is tight enough to be able to classify it as indicated ounces.
Right. Yep. So basically standard, just how it's done, following NI 43-101.
Yeah,
Good.
exactly.
There's to go back to Omampe, what you said there. There's this strip of land between your main land package and the package where Omampe is. Who owns that? And do you plan and try and buy it this year?
Yeah, I mean, that's owned by a private company. It's an area that obviously sits between the two that we haven't really focused in on or prioritized. If we wanted to potentially acquire that, there'd potentially be the opportunity to do that. But again, we've got so much acreage and targets across our 248 square kilometers that, trying to go and buy additional acreage at this stage doesn't make a ton of sense. Omampe, again, we were able to stake that, directly from the Minerals Commission. So, that kind of opportunity makes sense for us. It's relatively low cost. It provides additional opportunity from an exploration perspective. So, that was why we decided to stake the Omampe acreage.
I'm just asking this from an autistic perspective myself, because when I look at that, and then I look at what's north of Niam too. There's this little hole in the map, and I'm thinking, what's happening? Why is this not yours?
So that specific hole north of Niam, there's a village in that area, so that's the main reason why we carved that out of our land package. There's, given all the different areas and targets across the project, doesn't make sense for us to have that as part of our land package. So when it comes time to, when we had to do some relinquishing of acreage, it made sense to carve that out because it's an area that we wouldn't look to mine regardless.
Yeah, I understand. I understood that before. I think we mentioned last time. This is kind of just me being a complete autist here and just focusing on that one thing. But you bring up a good point though, and that's locals. We talked about that before. I know you have local support. Did you have to get anything special for this drill program? Just inform the locals or get their nod off, or like how did you? Is that all checked?
Yeah, I mean we're fully permitted to drill across our 248 square kilometer land package. So yeah, so I mean obviously you engage with local stakeholders, you make them aware of what you're up to, but yeah, we've never had any issues from a drilling perspective, exploration perspective, and really where our resource sits. There's a little bit of subsistence cocoa farming, but it's really there aren't villages or cities or any of that kind of stuff. So it's pretty easy to move around. The bulk of the area has been logged, so it's all second, third generation forest. There's logging roads throughout our property, so that's another one of the advantages, is we can leverage off of that infrastructure to be able to access all these different drill areas. So yeah, so we we're ready to go and drill anywhere we want.
Right. Okay. You mentioned, we talked about this earlier too. You're well cashed up. This is RC drilling. It's in Africa, so I'm assuming it's cheap, which also makes me assume that there's no need for you to raise capital before getting assays out to market. Um, is that right? Like, am I assuming right? Are you covered for G&A and everything else outside of drilling as well?
Yeah, so again, we've got those $3.3 million worth of warrant proceeds that have come in. I mean, 3.2 of the 3.3 are in. If you look at our, as you highlighted at the start, our cash balance at the end of March was 2.6. So 2.6 plus 3.3 is just under $6 million. If you look at our cash burn, we burn about $300,000 Canadian per month. So knock 3 months off that, it's about 900 grand. The way to look at Newcore today is we've got $5 million, which fully funds our 10,000 meters of drilling, as well as 9 to 12 months of G&A. So we're in a good position from that perspective. We're also, as I mentioned, going to apply for a mining lease. So that's a relatively low cost exercise. We're continuing to do a significant amount of metallurgy across the project. You can never do too much met work. The met work that we've done to date is already pushing a PFS level, but we want to continue to obviously test the material on our project. We're doing hydrological studies. We're doing condemnation drilling, geotech studies. So all of that work is fully funded within the budget that we've got allocated with that 5 million Canadian of cash.
What kind of network are you running or hoping to be running here? Is this a 45 and 90-day test? What are we looking at?
So we've conducted a number of column tests. We're over 20 column tests done to date. Those typically run anywhere from 60 to 90 days from a leaching perspective. I mean, you can go online or go into our presentation and you can see the leach curves. So you're typically recovering the bulk of the material within that kind of 30 to 60 days. And then you've got that tail that runs out to 90 days plus. So column tests is something we're continuing to do. We're also assuming agglomeration for all of the material on our project. So we're continuing to look at different cement levels to find the optimal ratio from that perspective. So those are a few of the things that we're continuing to do.
Again, focusing on the oxide gold here, and we'll touch upon the sulfides maybe later on a little bit too. But what are you specifically hoping to get in terms of recoveries? I know last time we spoke, you told me that over 90% was doable. What are we hoping to get?
Well, so if you look at the PEA, what's used in the PEA is 81.8%. If you go and read through our 340-page tech report, you'll see that Lycopodium was recommending 88-89% recovery. So we see an opportunity to potentially increase the recovery rates in future studies. But the reality is, if you look at the economics of our project, and you highlighted them at the start, at an $1,850 gold price, you're looking at an after-tax NPV of 371 million, after-tax IRR of 58%, and a 1.6-year payback. I mean, at spot gold, you're looking at 632 million of after-tax NPV, 92% IRR, and just over a 1-year payback. So we don't need to be aggressive with any of the assumptions within our PEA. So we've left a certain element of conservatism in there, which then in future studies, we'll be able to potentially, sharpen the pencil a little bit more and take advantage of the fact that we've been conservative with a lot of the aspects of our project today.
Right. Okay. So to recap so far, 10,000 meter drill program starting. Oh, we didn't actually talk about when exactly it's going to. When exactly is it starting?
We're looking to get it going in the next month.
Okay, so by the end of July, then.
Yeah, that's the
Okay,
plan.
good.
So we'd like to start seeing some initial drill results coming out within 3 months, let's say.
3 months from July 7th.
We typically
October.
put drill results out in batches. So, as we get a batch of results back, then we'll look to release those to the market.
Good. You're stealing my questions, Luke. Maybe you should take my position here. That's what I was going to ask. But okay, so you have 10,000 meters starting by the end of July, fully funded. GNA is also funded for the period of doing that drilling and up until the assays come back. 80-20 split between infill, step out. So it's 8,000 meters on infill, 2,000 meters on step out, about 100 meters on average in terms of depth. Assays in October. Okay, what about the metallurgical work, or like how's that going to go chronologically? Like, are you going to have the met test results out and then trenching and then assays, or how is that going to look like?
Yeah, I just kind of look at it as we'll constantly have a flow of met test work being released. So we're just continuously doing met test work. I mean, it's not that expensive to do, but obviously from a project de-risking perspective, it's hugely important. So, when one set of tests finish, we start another one, and we're constantly doing test work from a met perspective. I mean, if you look at the last few years, we've completed over 300 met tests. So, so that's kind of how you can look at that, as there'll just constantly be met results coming out every few months.
Okay. But so over the summer, you're still going to have news coming out over the summer.
Yep.
Okay, good. And then I suppose, and that's way out in the future, but as I mentioned, I didn't want to ask you about that. PFS, what's the timeline you're going for commissioning the PFS?
So our goal is to have a PFS released within 12 to 18 months.
From this recording, basically.
Yeah.
Okay. So by the end of, definitely by the end of 2025. Okay. But that means that next summer you're gonna have to drill more. What's the plan? Like, how many meters do you have to drill between now and PFS?
So we've got this 10,000 meters. So portion of that is the infill drilling required. We're just finalizing the overall drill program that that we think we'll need to ultimately convert the appropriate number of ounces from the inferred to the indicated category. One of the nice things, if you look at our resource today, we've got 740,000 ounces that sit within the indicated category. So those are ounces that can go directly into a PFS today. We've then got an additional 970,000 ounces of inferred resource. If you look at our PEA, it's about 1.3 million ounces that fed the PEA. So we need to convert about another 550 to 600,000 ounces from the inferred category into that indicated category if we wanted to wrap the current mine plan around or include that current mine plan in a PFS. So that's what we're working through at the moment is, how many meters do we think will be required to convert that 550 to 600,000 ounces.
But you don't have that answer for me now.
Not right now.
Okay. Because obviously I'm thinking, how much more money is it going to cost? Because this is funded, but between this and PFS, how much more money is that going to cost? Rough idea that you can give me?
Probably around 10 to 15 million.
Okay. Yeah.
Canadian.
Good. Well, I was again looking for a ballpark, as long as it's not 50. But because for the PFS,
Well, the other big thing is, again, back to the drilling, which becomes the most expensive part. It's shallow 50 to 150 meter holes. So RC drilling, relatively shallow holes. So that's one of the big advantages, again, is, the drilling that needs to be done. It's low cost drilling.
Well, that's where I wanted to go with this, is thinking about, is it going to be the shallow drilling, or do you want to include the sulfide mineralization in the PFS as well?
Even the sulfide mineralization, you're kind of down to maybe 200 meters. I mean, if you think the average vertical depth of the pits that constrains our inferred and indicated ounces is only 75 meters. So, in theory, from a conversion perspective, our holes should only average 75 meters. There are, certain areas that may be a little bit deeper. So maybe that pushes to an average of, call it 75 to 100 meters. But it's really, relatively shallow drilling that needs to be completed from a conversion perspective.
Okay. But you are set on including that sulfide mineralization in the PFS. I mean, that's decided on.
Yes, portions of it. We're obviously not going to focus on converting underground ounces, because those aren't what none of those ounces were used in the PEA. We're really just focused on the ounces that are being mined in the PEA.
Sure. Yeah. Well, and that makes sense. I assume it would have been a different calculation, more complicated one too, and a completely different PEA if you had to include that. And it's also going to make the PFS more complicated if you had to include underground as well. And it's already good enough, right?
At the end of the day, Antonio, we like simple. We like straightforward. And if you look at our PEA, it's a very simple, straightforward, open pit heap leach project. Complexity in mining isn't helpful. So it's one of the real, again, advantages of this project is it's low capital and it's simple. So, those are elements that we're going to continue to focus on, is making sure that, we've got a project that we can deliver and ultimately put into construction.
Right. Yeah, that's kind of that's always been the thesis since I've been exposed to the story. So it makes sense. I'm getting a better idea, a better picture of where you want to be taking this over the coming months here, Luke. What else are you doing in the meantime? Are you ramping up marketing? Are you going to conferences, or what are you doing?
Yeah, I mean, things on the kind of conference and marketing side of things typically slow down a little bit in the summer. But then obviously in September, they typically ramp back up. So, things like Beaver Creek, which is, a conference that a lot of investors go to, as well as a lot of corporates, attend. So that's something we'll attend. And then we've got a number of other things planned for Q3, Q4 of this year. We typically try to, kind of balance focusing on North America, focusing on Europe, as well as other jurisdictions. We're always very active from a social media perspective. I mean, we've got, a YouTube channel. We're active on LinkedIn, Facebook, those various Twitter, I guess X now, those various platforms. So yeah, we'll continue to obviously make sure that our investors and prospective investors are aware of what we're up to and how we're continuing to move the company forward.
Great. Well, I'm again getting the gist of it here in the picture. What am I forgetting to ask you, though, Luke? What did you come here hoping to talk about that I'm not bringing up?
No, I think we've kind of gone through things in a fair bit of detail. I mean, optionality, I think, is one of the big things. Obviously, last time we met, we talked a lot about the economics of the project and the PEA, which we're now going to push to a PFS and look to put into production. We've got the full support from our institutional owners, and they're keen to see this project in production. So we're focusing on that. But then, the true district scale exploration upside that, we've got at our project is obviously something we don't want to lose focus on. And it's something that we will continue to ultimately push forward. And hence a bunch of your questions in terms of, how much of the drilling are you focused on from PFS versus exploration upside. So I think as shareholders, that's one of the real nice, things you get with Newcore is you get that optionality of cash flow from a production perspective in the relatively near term, but then also huge exploration torque as well.
That's it. That's the pitch right there, Luke. And I really appreciate the transparency. I appreciate you being in depth, and I appreciate you investing your time in me once again. Loads going on going into the summer and over the summer, so hopefully speak to you again before long. But I'll let you go on about your day now, and I will let the next CEO in the barbecue here, for which I'm traveling to, lucky me, yet another warm place, Mexico to be specific, is where I'm traveling. It is also where I'll be getting an update on one of the largest junior-owned silver asset bases in Mexico. And I'll be hearing about them from Jim McDonald, the CEO of Kootenay Silver. The company is listed as KTN on the Ventures Exchange in Canada, where an average of about 100,000 shares trades each day, with a 52-week high of $1.45 and a 52-week low of 60 cents, with a market cap of about $64 million and about 60 million shares outstanding. Today, this is a $1.06 stock. There are 21.7 million warrants and 5 million options, leaving the number of fully diluted shares at about 86 million. Famous names currently invested in the story are Eric Sprott, the man himself, who owns about 5% of the company. There's Condar in here, or Condir, or however you're supposed to pronounce it, Condir. I'll try in French as well. But they own 6% of the company, while insiders own about 4%, and institutions count for about a third of the company, or 32% to be specific. The last financial statement, which is dated March 31st, shows me $4.1 million in current assets, most of which, so $2.7 million to be specific, in actual cash, with about $1 million of marketable securities and a decent chunk of prepaid expenses on top of that. I don't see any long-term debts or any major liabilities, but I do see about $350,000 worth of account payables on the balance sheet. That same financial statement from March also tells me that on average, over the last reported 3 months, Kootenay reported about $200,000 a month in administrative expenses. And that's excluding options-based compensation, and the majority of it was spent on professional fees and offices. That's what's making up the bulk of that. Whereas about the same amount, so about 200 grand a month, was spent on drilling, with the majority going into La Columba, which I'll tell you more about in a second, and specifically geological consulting and prospecting on La Columba leading up to the drill program that is currently ongoing. And this puts the administration to exploration ratio at about 1-to-1, but that will have changed with the current and upcoming quarter as well, because the company is, again, as I said, now actively drilling. And as it always is, of course, please understand that this financial statement is nothing more than a snapshot in time, in this case, specifically at the end of March of this year. And this really only covers 3 months of time, which might not be representative of everything that Kootenay has going on, specifically because they also did an oversubscribed financing, raising over $10 million after this financial report was published. So go to setterplus.com, .ca, better said, and go to the company's website as well to look at all the numbers yourself and make sure you're getting the full picture. And talking about full pictures, as I mentioned at the beginning, this is not my first interview with Jim here, so I'll save you the half-an-hour company introduction overview, but just very briefly, maybe 3 minutes. There are 3 parts to the Kootenay Silver story, specifically a high-grade discovery, which is La Columba. That's kind of the main story here. But there's also 2 resource properties offering leverage to the silver price, and is a portfolio of early-stage exploration assets offering some optionality. The focus here is, of course, La Columba, as I mentioned a couple of times. That's the company's flagship asset. It's located in northern Mexico, or the north central Mexico, if you want to call it that. Kind of a unique project, this, because it's a high grade vein system, which is actually not unique geologically speaking for that part of the world. But what is unique is that it's actually not been explored for over 40 years. So no modern techniques, no modern exploration on it has been happening on the project, basically. Ever, despite grades here being in excess, sometimes of over 2 kilograms of silver per ton over varying intercepts, intercept widths between 2 meters and sometimes even 35 meters or in the higher end. There is this is where the majority of the money gets spent, as I mentioned, and there's a 20,000 meter drill program that has to be completed on this before an MRE comes out. And that's a phased project, a phased approach really to the project, of course. And there's a 5,000 meter drill program going on right now, with that MRE being expected by the end of the year. Some of the recent grades that have been coming back from that drilling at La Columba, yeah, well, first of all, there are already grades that are coming back from that current drilling, and some of those grades are up to 920 grams per ton of silver. So this is almost a kilo of silver per ton, with over 4% lead zinc, though it is over narrower widths of between 1 to 3 meters. But we'll talk about that more in a second. This, however, did increase the strike length from 45 meters to 650 meters. So this is an almost 50% increase, which is of course something that needs to be discussed later on as well. And one of the other main selling points for the company outside of the exploration upside potential at La Columba, of course, is, as I mentioned, the leverage to the silver price, which is derived from their ownership in two resource stage projects, which again, I won't spend too much time on them, but they're both in northern Mexico as well. There is close to 215, so 215 million ounces of silver equivalent in the M&I categories, and there's 55 million ounces in inferred. So call it 270 million ounces, and I'm rounding up, but so 270 million ounces of silver across both categories of the NI 43-101, and they're split between La Negra and La Cigarra. Trying my Spanish here a little bit next to my French as well, and respectively, those assets, those resources were announced in October of last year and January of this year. There are some other assets in the company. There's even some stuff in Canada, but they're kind of on a bench for now, including yeah, I'm not going to go through them. I'm not going to spend any time on them, but instead, maybe I'll just think about shutting up for now and kicking it off with a question here, Jim, because all that everyone seems to be able to think about right now when it comes down to not only silver stories in Mexico, but just generally stories in Mexico. Like I had Go Gold on the channel a couple of months ago, and most of the questions were about the political situation there. And you and I have discussed that last time as well. But what's happening there these days? Like how's the sentiment towards mining? What do you make of the whole situation?
Well, it's hard to say. We've gone through 6 years of a president who was very antagonistic towards the industry, well known for that, very bombastic in his statements, and he went out of his way to make a villain out of the industry, which is really unfortunate, given that it's a large part of the GDP in Mexico. There's 500 years of mining history there. And really, when you want to tackle opportunity for poorer regions of it in any country, typically it's the mining or some resource industry that will provide opportunity, because the deposits are quite often located in remote areas. And many examples of that. I was a founder of National Gold, which eventually became Alamos Gold when we merged with John McCluskey's and Chester Miller's Jr. to help us finance the acquisition of the Mulatos deposit in Sonora, Mexico. And within, I think it was, I recall now, February of 2003, we merged, and within under 3 years, we were in commercial production there. And employing hundreds of people. I haven't been on that board for over 10 years, but it brought in new schools, clean water, all kinds of medical help. We had a medical center at the mine. There was even a baby born there right at the mine site. And then scholarship programs. I don't know how many students they've put through post-secondary education now, in addition to the schools they built locally. So, huge positive impact there. So it's very unfortunate for the former or the outgoing president to be so antagonistic against the industry. And the last year, he attempted to bring in a reform. It's been challenged through an imperial process by virtually every company out there. And also, the Supreme Court is signaling that they don't agree with this law. He's had laws that he's brought in before challenged and struck down because they were for various reasons. And in this case, it was not constitutionally done correctly. And so that reform is still up in the air of how it will land. The way it sits currently, if you have registered concessions, there is not that big of an impact on you. You continue as before. If it goes through the way it was written, it will have a large impact on grassroots exploration, on acquiring new ground. And so that's where the real huge impact will be. Now we have a new president coming in October 1st. So she's scientifically educated, an engineer, I think it's an environmental engineer. She says she will follow AMRO's, the previous president's policies in general, but she does have her own style. She's showing that already, and what we see so far is she listens and considers the different sides, and so it's a very different approach. I expect it will be a more friendly president to the industry overall, but there's a lot of question marks of how all of this new legislation and proposals will end up. We don't simply, at the moment, we simply don't know. And we'll see in the next few months how that's going to look.
It also, just for you, I'm thinking, like, how much does it really matter for explorers and developers? Like, it's not like you're bringing a mine into production in the next 2 years or anything like that. Where it matters for you, or where it matters to me as a retail investor in your case, is the cost of capital. But you also don't seem to have issues raising capital or telling the story. It doesn't seem like you're finding it more difficult, given that you just did an oversubscribed financing that was quickly oversubscribed, actually. And I don't mean to blow any smoke up your back alley, but how come? I mean, why? What's the feedback that you're getting from investors there?
Well, it's driven by the Columba discovery there, the high-grade vein system. And we, geologically, we're in a great setting. It's really what's emerging there is a new vein district that has not been recognized. And the reason it's not recognized is because the erosional level has not exposed it, or has barely exposed it. So what you do see of the vein system is so poorly exposed by erosion that what appears in surface immediately is a lot smaller than what is actually there. So and the work we've done over the past 4.5 years is demonstrating that this is a pretty big vein system, in fact, and very underexplored, as you pointed out at the head of the show. And when we took the option on over 4.5 years ago to earn 100% interest on the project, there had been no work done in nearly 40 years, and so this thing was vastly underexplored, really not explored at all. And what we've shown through drilling in our work and the drill results is like, hey, this is a very strong vein system with some incredible grades and widths showing up in various different veins and structures. And the size of footprint we see, the aerial extent of the vein system, is such that you could have 100 million ounces of resource here, or maybe multiples of that. So when you compare the aerial extent of our vein system with other more advanced and well-known discoveries in Mexico, like the Panuca discovery by Vizsla and the Las Chispas discovery by Silvercrest, which is now in production, we are of a very similar size of system in terms of aerial extent. So that's one of the first things you look at as a geologist in exploration is, okay, what's the size and strength of this system? The magnitude of it gives you an idea of the magnitude of what the resource might be. Now, that's one thing. It doesn't mean that you're going to have a resource like that, but then you start drilling. And our drill intercepts certainly are supporting that thesis. And when we're getting intercepts like 34 meters, a half kilo silver. That's a pretty incredible intercept. I think the true width on that is around, that intercept's around 20 meters. And the core of that intercept was, drill intercept was 9.7 meters at 1,700 grams per ton, not including the lead zinc. So pretty fat, substantial zone. Yep. And that's the D vein where we're drilling now, which you mentioned at the head of the show, where we've just increased the strike length by nearly 50%. So yeah, when you combine the drill results, I mean, that in the industry, we call that the truth machine. And all kinds of targets look exciting exploration wise until you put the truth machine on it. But when you start drilling, now the rubber hits the road, and we're getting all kinds of great intercepts on various different veins, especially this D vein. And so, all right, now you can see the potential, and then the investor can see that, especially the sophisticated investor or the analyst, and they see that potential there. So it's a very, very real potential for a big, high grade and discovery resource here. And the thing about the high grade is that works at any kind of silver price. And so that's what's critical. Our other resources start to look interesting at when silver gets close to $30. 2 out of 3 of them do. And so, and in the case here of La Ceguera, what we're talking about is classic high-grade Mexican vein systems. This is an intermediate sulfidation type. And so epithermal systems are basically, vein systems are basically broken into low sulfidation and intermediate sulfidation for the most part. And the difference is that the intermediate sulfidation vein systems have quite a thick interval of them. They can go to depth quite a ways. If you're near the top of your system, those things can go to 600, 700, 800 meter depth, sometimes more even. Whereas a low sulfidation productive horizon is usually around 150 to 300 meters. So we're in that intermediate sulfidation type. So the depth potential could be pretty good. And that one hole with 34 meters, a half kilo, is the deepest hole on that particular vein called the D vein. And it's still wide open to depth. And so it's pretty exciting discovery. That's what's generated the interest. And in that last financing, it was combined with the timing. Sometimes you have some serendipity and luck on your side. And the timing in the market, silver price was starting to break out. And suddenly there was an appetite in the market for silver deals. And when we hit the market, and that's combined with the quality of the asset and the discovery we're in the midst of, that's what can happen. And very rapidly, the book was filled, and there was an upsized, and we closed in the financing.
I appreciate you bringing all these things up because I want to talk about them later on, and you're going to make me look smart because I'm going to be bringing them. Let's maybe take it from the top, though, because you're currently drilling at La Columba. Give me maybe a status update here. Like, how's the program going? How many meters are drilled now, and how many more left?
Yeah, so we had started earlier in the year with a 5,000 meter program. Then after the financing we just spoke of, we expanded it to 20,000 meters. 20,000 meters because that's what we think we need to get to a maiden resource. And we want to do that by year end. So we have we've been drilling since early April, and we put one release out. That was the release on holes 152, 153, which expanded the strike length 200 meters on that particular D vein. And we'll be adding very soon here a second drill rig to accelerate this program. The initial focus is going to be on that zone on the D vein, and to find basically the edges of that mineralized chute. So when you're in these veins, you develop what we call used to be called ore chutes, but for 43-101 regulations, you can't call it ore until it's proven to be ore through a feasibility study or you're mining it. but they're mineralized shoots. And what that is a vein is just a plane, like your hand. And then inside of that, you'll get these zones of dilation where you'll get them opening up, fattening up like that. That will be your mineral zone. So whatever shape that is and whatever dimension it's going, that's your mineralized shoot. So we're trying to find the edges of what we have there. And remarkable, last fall, we had a small program of 12 holes on that vein, stepping out modestly, hitting every single hole. And we've been hitting in every hole on this program on that structure. And it has the potential to be about 1,000 to 1,300 meters long. And then it hits another structure we call B, the B vein. And so the first job here is just to find the edges of that mineralized shoot. How far does it go? So we were doing some pretty aggressive step outs. That was a 200-meter step out we released. We're going roughly at 100 meters at a time right now in a straight line across just to find the edges. And then once we do that, we'll come back and we'll start to drill above and below all those intercepts and then go to depth and get enough density of drilling so you can do a resource estimate on that zone. Once we find the edges of that, the second drill that's coming in will also be put onto that vein. And once we find the edges, then we'll move one drill to the other zones, like on the B vein, where we've got intercepts of 4.6 meters of almost 1,200 grams per ton, and start defining that zone. And then the first rig will go back and just systematically start doing a grid pattern on that D vein, so we get sufficient density for be able to do a resource and define the limits in the down direction, the down dip direction at depth. So in addition to all of this, we've already drilled, before we started drilling this year, 147 holes and 30,000 meters. So this year's program so far, we've completed 4,000 meters out of the planned 20,000, and we're adding that second rig to accelerate that. Of the drilling that was done prior to this year, over 40 holes were on the historically worked vein that was worked on in the early 1900s, where they had put down a shaft 200 meters and 6 levels and tunnels off of that shaft. Just got into production when it was shut down by the revolution in 1910. Then there was a little bit of small scale mining done off of that old working in the 1958 to 1960 period. We think about 100,000 tons were ever mined out of that vein. So it was the assay records from that old mine that attracted us to the project to begin with, because it showed some incredibly consistent high grade along those tunnels. Pretty unusual how consistent it was in good grade. So we picked up the option. The first thing we did was drill that zone to confirm those grades, and it proved to be true. And now we've got over 40 holes on that historic vein, F vein, and it defines 700 meters of strike length down to 200-meter depth. It's narrower than the D vein. The F vein intercepts will typically be sort of 1 meter to 5 meters thick. And then there's a stockwork zone of low to medium grade around that fattens that up more. And in addition to the historic F vein, there's a second vein parallel to it, we call a hang wall vein, that gets some pretty incredible intercepts, so up to 2 kilos over a couple meters. And so that was a pleasant surprise and not unexpected in these vein systems. You're going to find structures that don't come to surface are going to be blind. So there's enough drilling in there. We know there's a resource that needs to be estimated. We may need to add just a few holes to fill some gaps there. It's still open to depth on that particular vein. But the D vein is better. It's better because it's wider, and the grades are every bit as good, if not better. In the D vein, we're hitting the intercept I talked about, the 34 meters, a half kilo. 90 meters above that is an intercept of almost 18 meters of 650 grams per ton. And the last holes we released there, we were getting upwards of 11 meters of over 400 grams per ton, which was 200 meters away from the nearest holes. And so pretty big step out, and it's still there. So another important aspect of these vein systems is you will typically get some structures that are key, some veins that are the key veins that hold most of the ounces. It could be one, could be two, three, or four different veins that will hold the majority of the ounces. And the D vein certainly looks like one of those. And it's those zones that make everything else work. So you could have dozens of smaller zones that add up to a whole bunch of ounces, but you're going to have a handful of zones that will maybe have 50 to 80% of your ounces contained in just a few areas. And that's really what makes these vein districts work. And that's very typical in these type of systems across the entire world.
How are these different zones that you're saying, like the D vein and the B vein? How are they? Do they compare in terms of alteration and the mineralogy package that's behind them? Are they geologically similar?
Yeah, they are. They're very similar. D vein seems to have more base metal showing up, and we haven't found the bottom of that yet. It's still wide open, but they're very, very similar. The really interesting aspect of this the vein system district, if you will, is that it's almost entirely preserved from erosion. So you can go on our website and you see some images there. You can even see we're sitting in an old volcano, and we're sitting right in the cone of the old volcano, and our vein structures cut across that cone down into the bottom and up over the rim. 4 kilometers in one direction, northwest, southeast, and 3 kilometers in the other. So you got 2 sets that are like this. And the old mine shaft in the vein that was worked historically is at the bottom of that old volcanic cone. So it's the erosional low point. And it has just exposed the top part of the veins where they become productive, where they have silver grade, where they become strong and consistent. And when you go up in elevation, you imagine yourself in a volcanic cone and you're climbing out of it, well, up the slope to the rim, you're gaining elevation, you start to lose your quartz veining, and it becomes erratic. You can still follow that structure, but you also start to lose the silver values. Till in some cases, only 80 meters higher in elevation, you're into background silver in your structure. But when you drill down to that erosional level where the silver begins, which is in our case, as a rule of thumb, it's around 1,750 meters above sea level, as a general rule of thumb. You drill down to there, even though at surface you have 5 grams, you could have a kilo underneath it. So geologically, it's a textbook example. A great place to do field schools for geologists and geologic students here, because you can see the thing from the very tip top where you have nothing, right at surface, right into where you're just beginning to get into your productive part of the system. We're calling that the grade line. And then underneath that is where the real action starts to happen in terms of grade and thickness on these veins.
We mentioned the grade and thickness of these veins. That's something I wanted to talk to you about, because there's quite the variability that I can notice in both. How are you going to be dealing with that in the context of working this towards a resource, and how is that going to influence your resource?
Well, it's good to have thicker veins because it builds up tons and ounces a lot faster if the grade is there. So you've got more volume. So if you've got a panel that's 1 meter wide versus a panel that's 3 meters wide, well, in the same area, you've got 3 times the volume in tons in the same area. So, the thickness of the veins is important for 2 reasons. If you assume you have the same grade in a 1 meter vein or a 10 meter vein, 10 meter veins got 10 times the volume. Now, the other thing that's really important is the cost of mining that. When you're mining 1 meter, you're diluting to a minimum mining width, usually of 1.5 meters. So you suffer dilution. Plus, you've got space constraint. You can only break so much rock in that small space at one time. It costs a lot more money to do it per ton. If you got a 10-meter wide vein, you're spending about the same amount of time, but you're breaking 10 times the number of tons. So now your cost per ounce becomes substantially lower. So your mining cost is a lot lower with the wider vein. So you really want to see those wider veins, preferably. So it does, how it impacts the resources. Wider veins will build resource faster, and then you need enough density of drilling to be able to have confidence of the continuity between drill holes. And then you build what we call wire frames, which are, you take your contacts and you're building a 3D body out of these wire frames. And then from that, you can calculate a volume. And then there's formulas and programs that will calculate the average grade spread through that volume.
What's that going to be for you specifically, though? Like, what kind of intercepts do you have? Is it 25, 50 meters for the resource?
Spacing between drill holes, you mean?
Yeah. Step out, yeah.
Yeah, so we just had a QP on site a few weeks ago to get some guidance from him. And as long as you're getting good continuity, it hits 100-meter spacing between holes can get you to an inferred. And so indicated, you're going to need to close that in. And project to project will vary, and different deposit styles will vary on that spacing. But on a vein deposit, that's what he's telling us for this project. And so that, we're looking to get at least that and closer to get inferred and indicated category resources.
Okay. Are you going to be doing any met work to go with that for the resource?
Yeah, absolutely. We will. Yeah, we've started some met work now, and there'll be met work go along with that, and with that resource naturally.
Okay. Are you guiding anything in terms of recovery, or like what's typical for this region?
Well, we're sitting quite a ways from any of the nearest deposits, about 50 kilometers from another vein system, which is completely different. So it doesn't provide guidance. The only guidance that we have are the historical records that were showing that recoveries were sort of ranging from 75% to 85%. And this is gleaned off of old mine records, of which there are not very many. And then sort of back calculating grade reported in the mine against grade and some of the tailings that are sitting there. And so that's what we know right now, but obviously we need to do a lot more our own modern metallurgical work. And then, each vein will have to have its own work done on it to see if there's continuity across different veins, or maybe different veins are going to behave differently. So all that work needs to be done. How
do variations in lithology along the D vein impact the grade and continuity of the mineralization? Are there any specific rock types or anything that are more favorable than others?
So the D vein is in what we call a rhyolite unit, a rhyolitic dome. So it's the sort of resurgent dome or kind of rock you would see at Mount St. Helens, for example. And that vein so far is all in one rock type, one lithology. The historic mine, the F vein, is in a different rock, dioritic intrusion. So it's in a high level intrusive rock, slightly different composition. And so you have good grade in that historic mine. It's narrower than the D vein. So it could be that those rhyolitic rocks are breaking easier, or maybe that structure was just stronger. We don't see any lithologic control there on the D vein. For this program, we're going to look to go 100 to 150 meters underneath that deepest hole too, at depth. So we don't yet know if we're going to start to see a real strong zonation going to depth. That's one of the things to be determined.
Okay. How deep is that in total? Oh, go ahead.
Oh, so how deep on the D vein? The deepest hole is around 1,550 meters above sea level. That's that hole 125 with the 34 meters, half kilo. And so we want to take a cut 1450, 1400, and we've even got some designed to go deeper underneath that. And quite often these systems will zone into more base metal rich at depth, and we don't have enough drilling to really see a consistent zonation yet. But this program will go a long ways in answering some of those questions.
Yeah. With this recent increase in strike length, though, is it getting more complex from a branching or a faulting perspective, or anything else you're seeing that's kind of making it more challenging for you to wrap your head around the system?
Well, no. The one of the things about this vein system is the veins and structures are cutting every rock type we see so far. So it was very late stage, and it has not seen really any deformation or post-mineral faulting of significance. There is faulting there, but the displacements, the potential displacements we see will be pretty small, orders of meters or maybe 10 meters or something like that. It's pretty young deposit, obviously, and you can actually see the old volcano shape sitting there, probably in the position it was when it formed. It hasn't suffered a lot of faulting or a bunch of tilting, no folding at all. And so it's like a pristine, intact system. And it's a geologic dream for a geologist to go in there. Not only is it a great classroom for these type of vein systems, also a great classroom for volcanologists, because you can see so much of the volcano in place in different units that rock types that came out of it.
But it's only a couple of million years old.
Well, don't really know the age of it. I think it's probably older than that. When you look at regionally in Mexico, a lot of things happened around 35, 38 million, or let's say 28 million plus years ago with these epithermal vein deposits. We haven't dated this yet or attempted to, but it hasn't suffered much deformation or post-mineral faulting of any consequence.
Right. With that, how would having that volcano there, how is that going to impact the kind of the logistics of a potential mining operation here later down the road? Is it a plus? Is it a drawback?
Well, it's neither. I mean, you've got some relief there, vertical relief, so that's an advantage. In some cases, it's outside of the cone itself. There's some very good locations for facilities like dump sites or mill sites. Excellent locations, very close to the veins. So it's quite well situated. It's a basin and range topography, meaning you've got these low ranges and broad basins, valley basins in between. And so topographically, it's pretty favorable. There are some very moderate slopes and topography there to be able to build mine infrastructure on. And there's power very, very close. The highway in a straight line is within certainly within 8 to 10 kilometers. From the highway, it takes 20 minutes to drive on the mine road up into the exploration site. And from the international airport, it is about a 3.5 hour drive. So pretty well located. But for building mining infrastructure, the topography is pretty favorable. It's an extinct volcano, so that's pretty important. And
Pompey's.
so we're in good shape there.
It's to go back to how the drilling is going, though, that's whatever you have going on right now, that's all going smoothly. Like there's no major core loss or I don't know, unstable ground conditions or whatever else you might see. Everything's going fine.
Yeah, it's going well. You'll always, in any project, you're going to have issues with broken ground or faults. The faulted zones can be very broken. Yeah, we've only, I think, well, in this program, there's only one hole where we couldn't reach target depth. And out of the whole program, I'd say there's certainly less than 1% of the holes that you couldn't finish.
Okay. So it's nothing, I mean, there's nothing major. It's not going to impact anything, basically. What about everything else? I mean, locals, water availability this season, the weather, how's everything right now?
Yeah, so weather-wise, we're entering the rain season. And so that's when you may have some challenges with heavy rains. You want the rains. I mean, you're in a semi-arid desert. And so, yeah, always welcome rain. But you can function here year round. Yeah, it's pretty high elevation, over up to nearly 2,000 meters at the high points. And so you do actually get snow. We've had snowstorms at the project. And but you can operate year round there. That's not an issue. It's very easy to operate year round.
Okay. The locals are happy with you operating there. There's nothing, no opposition.
No, we've got surface agreements with everybody. We've been there for 4.5 years now. Got good relations with all the locals, and so in good good stead there.
Okay, good. Well, I mentioned water and all these things. I know that they can be an issue sometime. Once I heard there's an avocado mafia in Mexico. I don't know exactly what region they are, but are you dealing with any of that?
Avocado mafia, no.
Well, good for you.
No security issues here. It's a very stable, safe area. And so, yeah, no issues like that.
Okay. What about cost of drilling? How much is the program coming up to now in terms of per meter?
Yeah, so now we're about 300 Canadian all in. That's the whole program. That's our geologist, that's the assaying, that's the drill, everything.
Okay. But so the money you raised is going to be plenty for you to finish that drilling, get it over the MRE stage, I suppose, or like, how do you look at that?
Yeah, that's right. So that 20,000 meters, I believe, will get us to, and that'll be by sort of the end of the year.
Okay. In terms of chronology, how is that going to go? And how are you going to be announcing these assay results? I assume sort of in batches, like a couple of holes each time. How much time is it going to be in between, and when is the next assay results coming out?
Yeah, so typically what'll impact that timing is just how many holes you get done. We like to batch them up. We'll typically have 4 to maybe 8 holes at a time. It's more meaningful then. And what impacts it is if you got any issues with equipment or drilling might slow it down. You may have problems with some holes. Assay turnaround can impact that. Right now, the assay turnaround is quite good. Don't anticipate any issues with that. And so I think we'll just have a fairly regular every month new drill news coming out now, from now to end of year. and then wrapping up at the end of the year, hopefully with a maiden resource.
Christmas present.
Yeah.
Hopefully. Are you guiding anything in terms of size though? I mean, how big do you think the present is going to be?
Well, we're not guiding there. It's so exploratory now. We're just finding the edges of this D zone. We would really like this maiden resource to be north of 50 million for a starter. That's a good start. And the potential here is certainly the 100 million ounce plus size on this project. That's very supportable. Given the drill results and size and number of veins and everything else. That's what we believe we got a real opportunity for here. And so that's where we're at that moment.
And are you kind of dead set on the corporate strategy here, where you say like we absolutely want to have a resource out by the end of this year, or could it happen so that with the currently ongoing drilling, you find some stuff there and you're like, oh no, we need to drill this out further, so let's push out the resource? Like, could that happen?
Yeah, you always have to be constantly adjusting according to your results. And what you do. I mean, you've got to be nimble. That's one of the advantages of junior companies. They can be nimble and react quickly. And so, yeah, in the case of something like that, certainly you got to consider that, be flexible. The alternative to what you just described is maybe, well, all right, we've built this thing up to meaningful size. We can finish the MRE and just keep on drilling, and then do another update in 6 months.
Mm-hmm.
That would be great. That'd be an ideal. It means you're having a lot of success. So,
sure.
But you're always adjusting. You're adjusting what you do, and you're also considering what the market's doing with how fast you spend dollars and you have to adjust when you have these calamities in the market, like the financial crisis which was huge, or even the COVID shutdown, which is another huge thing. You got to rapidly adjust what you're doing to reflect what's going on in the market, and in that case, to conserve capital in that case. Or on the flip side of it, the market's getting really hot, even though we've got lots of money for this program. Our stock price goes up, let's say the market's really hot, there's some more money available. Well, then you have to consider that.
Yeah. Well, if the money is there, take it. That's kind of the sentiment that I've been getting from most of the CEOs I interview on here. But you don't have to right now. So you're kind of in a good position, in my opinion, where you don't have to go and look for capital in mid-August or something like that. Like, you can finish this, prove up size, prove up grade, prove up recoverabilities, and then go to the market with that, which is, I mean, it changes the story completely. So that's kind of how I see it. I suppose that's kind of how you see it too.
Yeah, that's it. We're in a strong position because we've got money for the budget. We're going to have a good amount of money left over at the end of this whole program. So we're not under pressure. This is the first time in 4 years where we haven't been under pressure. It's a good place to be.
Yeah. What else is happening though with the company besides La Columba this year? Do you want to spend any money on any other projects or do anything else?
No, it's focuses on La Columba. I mean, if we want to get a meaningful size resource out of this, with the grade, the grade works in any silver price environment, and those are the most sought out assets at any rate. A nice high grade discovery.
But so do you want to, are the other assets that you have that are at the resource stage, is there a for sale sign on them, or is it going to take longer?
So what we did last year, we updated the resource estimate on La Ciguera, and then we also updated the resource estimate in Promontorio and La Negra. So in the case of Promontorio and La Negra, we had those two discoveries: the original high-grade polymetallic diatreme, silver, gold, lead, zinc. And then we made a second discovery called the Negro, which we hadn't done a resource estimate on. And that was it's a real interesting discovery, La Negra, it forms a prominent hill. The mineral zone sticks right out of the ground, so it lends itself to the potential for open pit mining with very little pre-strip required. And that discovery resulted in Pan American doing a deal with us where they were going to provide all the capital to go right to production, leave us with 25%. Because they had a plant 200 kilometers away that was about to close down, and they were thinking of bringing that plant up to La Negra. And to make that work for them and carry us like that, La Negra had to get to 50 million ounces. Now, it's not that big. It's about 22 in the indicated and about another 4.5 on the inferred. But the grade on the indicated, really great, almost 130 grams, a slightly higher cutoff of 50 grams per ton. It goes to, I think, 140 grams. Metallurgy looks pretty simple. There, it leaches really well, gets high recoveries. So it could be a real high margin producer for a small operator. And so we updated that report, not just to include that La Negra resource, but also to update the costing and metal prices and mining cost inputs for the original promontory discovery. And then that way, come up with a work plan for the project and have it ready for a silver bull market to do something. La Ciguera, same strategy. With La Ciguera, we felt for a long time that our resource model was underestimating the grade. And so we relogged all the core in the deposit and built a pretty rigorous geologic model, and then inputted the silver assays into it. And yeah, indeed, we saw the controls were tighter. We came up with a new resource that increased the grade in an open pit constrained resource from 85 grams to 105 grams. And a lot of upside at La Ciguera. Can't really, what would I say, overstate that, or, really want to emphasize the upside at La Ciguera. It's in the famous Parral district of Mexico. So, and we're on the extension of an area called Santa Barbara, San Francisco del Oro. We're on the northern extension of that mining district, and we're about 20 kilometers to the north. And that mining district's produced almost 500 million ounces of silver. And Grupo Mexico is mining today at 2,000 meter depth. So incredible mineral system here. And so we're dealing with a resource that's right at surface. And our deepest holes are only 150 meters vertically down for the most part. And a lot of area to be tested on the main mineralized structure. Lots of things undrilled, lots of targets. Inside the resource itself, there's an area we call the gap zone that's got potential for maybe 10 to 20 million ounces if there's continuity of grade and thickness through that zone that has to be tested. And so that's a really interesting project. It could turn into something very big. And so we updated that resource to reflect what we believe is a better grade. That turned out to be the case. And now it is also ready, like Promontorio La Negra, to have something done with it. And so our plans are, let this silver, like we believe we've entered a strong silver bull market now. So our plans are, let this silver market mature. These projects are ready. And then at the right time, we'll do something with them, either whether we're able to raise capital at a good price to advance them ourselves, moving towards PEA and pre-fees, or we bring a partner in. Or maybe if the market's really good and you can get an excellent price, you could sell the whole project and retain a royalty or something like that. So we've just kept those options all open.
Do you think the political situation in Mexico gaining more clarity, as you indicated at the beginning, is also going to help speed up that process? Like, are you talking to someone, some of the producers who are saying like, okay, let's see how this thing goes in Mexico, and that's when we can start pumping money back into it?
Yeah, well, no question about that, especially with these resources that are open pit constrained. I mean, that's a question because there's talk about banning open pit mining. Now, hopefully they don't do that. I've got my opinion on whether they will or not. I just say hopefully they don't do it, and because the vast majority of the mines in Mexico are open pit, first of all, and but that clarity on that is certainly going to help, like one way or another. And there's no question that will help. So right now, there definitely is a lot of standing on the sidelines by some of these producers. We'll see where how it all lands, and then we can make some make decisions on capital investment, for example.
Yeah, that's kind of how I imagined it too. Good, Jim. This has been a good overview. I know you have to go here in a couple of minutes. So what am I forgetting to ask you? What did you come here hoping to talk about that I'm not bringing up?
Well, I think we've really covered the basis here, Antonio, and let's look forward to more results in the MRE and getting this thing down the road towards ideally what we'd be doing early next year is more drilling to expand on our MRE and work to get us to a PEA next year.
Again, that's it. That's the pitch, Jim. That's you seem well grilled to me already at this point, and hopefully we can catch up again later this year, see what's in that MRE that you're talking to me about when you've been able to get that to the market. But I know we are already over time. I know you have to go now, so you can just drop off. I'll let you drop off, and thanks again for doing this. I'm just going to go right into the next barbecue, where I am apparently getting tired of the good weather. So I'm going to be flying to Canada, Quebec to be specific, where I will be looking for graphite for once, I suppose. I think I've done like one or two other graphite companies before, but this time I'll be hearing about it from James Cross, the CEO of E-Power Resources, a graphite exploration and development company. E-Power is listed as EPR on the CSE in Canada, where an average of about 25,000 shares trade each day, with a 52-week high of 30 cents and a 52-week low of 4 cents, with a market cap of about $2 million and about 35 million shares outstanding. Today, this is a 6-cent stock. There are 2 million warrants at 60 cents and no options, leaving the number of fully diluted shares at about 37 million. The last financial statement, which is dated March 31st, and where all of these numbers, by the way, in the share structure are coming from, and why I'm saying this, because they might be a little bit different. You figure out why here in a second. But the March 31st number, he also showed me $360,000 in current assets, most of which $200,000 to be specific in account receivables, with prepaid expenses being the next largest part on the balance sheet, and not much cash and cash equivalents, which is of course something that we'll talk about here in a second. I don't see any long-term debt, of course, no major liabilities that are out of the ordinary, but I do see about $400,000 worth of account payables and accrued liabilities on here. It is worth noting, though, that E-Power has raised over $200,000 since the publication of this financial statement, so the numbers of the shares outstanding, as well as the warrant, as well as the cash position, will be different by the time you're watching or listening to this. So make sure to head over to the company's website, check the presentations, but also use setterplus.ca to get a full picture here. That same financial statement from March also tells me that on average over the last reported 6 months, E-Power recorded about $100,000 in administrative expenses per month on average. That's excluding share-based compensation, and management and consulting made up the majority of the bureaucratic spend, as I like calling it. Whereas exploration expenditures were not here in a big way for this period. They were less than $10,000 a month, leaving the administrative or administration to exploration ratio at about 90% in favor of administration, which again I'll be asking about here in a second. But as always, as I mentioned, I need you to understand that this financial statement is nothing more than a snapshot in time. In this case, it is specifically at the end of March of this year, and this really only covers 6 months of time. So please don't rely on it. Go to the company's website as well, setterplus.ca, look at the numbers yourself and make sure you're getting the full picture. For E-Power Resources, part of that picture are the two properties they have in Quebec, one of which is called Tetepisca. That's the flagship property, really. Tetepisca is located in the North Shore region of Quebec. It's also in a graphite district of the same name, and it covers 120 square kilometers of land. It's not only land, though, as the district here hosts close to 5 million tons of graphite in reserves, with average grades of almost 28% and an estimated over 100 million tons of graphite in resources at an average grade of 14%. The reserves here are at the Lac Gère deposit, and the resources are split between Lac Tetapisca and the extension of Lac Gère, with the majority being at Lac Tetapisca, which is actually the northern part of the company's land claims. But there are multiple drill holes showing comparable grades across the company's land package, really pretty much everywhere. So there's anywhere between 12% over 5.5 meters to 30% over 3 meters. And there's also even some grab samples showing grades of up to 60%. Of course, those may not be representative since they are grab samples. The company is also following up all of this year, or well, a part of this year with some geological mapping and surface sampling. There's some bulk sampling that's going to be going on, with the idea of coming up with drill targets, which will eventually get drilled if and when funding is secured. And of course, that's going to be part of the discussion here today later on. And then after that, of course, moving towards a resource, but that's potentially, those are the forward-looking statements we typically talk about. There is a recently signed option agreement on this property that ePower otherwise owns 100% of, but there's now another party in play, and it's called Volt Power. Volt Power has the option to acquire 5% of the property in exchange for $680,000 worth of exploration expenditures during this year, so the calendar 2024, which will also give Volt Power 6.6 million shares of ePower, as well as then after this first condition is completed or met, Volt Power can pay $1.5 million to then actually acquire that 5%. ePower has, as I mentioned, another property that, as far as I understand it, is not at all focused. It's actually in the back burner for now, but the property is called Turgeon. It is about 180 square kilometers of land in southwestern Quebec. That would be the Abitibi Greenstone Belt. It's also a graphite target that some exploration dating back to 2019 showed the potential for decent grades, but that potential was then disproven, I guess, by some geophysical surveys and a little bit of more geological work, as far as I understand it. So there will be no more work happening here for the time being, but there might be another angle or another plan for this property, which I hope to learn more about in the conversation. And so all of this, may sound very positive, listening to me speak about these things, but none of it will be positive unless you're able to move this forward, James, right? And to do all that, to move this forward towards a resource and all these things, you will need money. But at the same time, at a $2 million market cap, getting that money is not always, well, actually, most of the time, it's not easy and it's not cheap. So how do you do it? How do you solve this financial bottleneck, if you will, to begin with?
Yeah. Well, at the moment, the answer is we've barely done it. We went public in January of 2023. And listed on the CSE, we did a direct listing. So we just floated shares of a private company that had been operating since late 2018. And since then, we did some financings in 2023 at, we did mostly flow through in 2023. We did some flow through at 46 cents per share and 35 cents per share. And there were some hard dollars along with that at slightly lower prices. And so we were able to get financing last year at last calendar year at a pretty good price, comparatively speaking, because our shares now are at 5 cents. So how have we done it? We were fortunate enough to finance or get most of our financing during 2023 in the earlier part of the year when markets were a whole lot better. But we did a financing at 6 cents in November, December of 23, and another at 7 cents. We closed it a few weeks ago, and call it February until April. And so we're reluctant to take in too much money at those low prices because the share count is something we've been very focused on guarding. We actually have 39.4 million shares at the moment. And we went public in January 23 with 22, or call it 23 million shares. And so, we've issued another 16 million, which we wish we could have done more of it at higher prices. But so this year we're keeping it pretty tight while the cost of financing is a large portion of the company. And one of the ways we do that is the deal we cut with Volt Carbon gives us $680,000 to spend this calendar year on exploration. And that's being spent right now. We have a crew deployed at the Tetapisca property. So our exploration budget for this year really is already funded by, or at least on Tetapisca, is funded by Volt Carbon. Now, there was some dilution to that because they get some shares of the company as well as the money is spent. They get 6.6 million shares as part of that deal. Now, they've already been given 1 million shares, and 1.6 million shares, and the remaining 5 million will be issued as the 680 gets spent. So the implied cost of financing there is about 10.3 cents per share. If it were, if you take that, if you do the math there as though it were a private placement, it's an option agreement rather than a private placement, but that's how the numbers work out. And if they wanted to exercise their option by the end of next year to acquire 5% of the Tetapisca property, that would be a cash payment of $1.5 million, which kind of sets a minimum value on Tetapisca at $30 million, and plus the exploration. So we haven't had to finance a lot for exploration this year, or really at all, other than that option agreement with Volt Carbon. We thought about doing additional flow through to supplement the budget, but figure it's really, we wouldn't get enough bang for the buck by doing it, because if you raise $1 million at this kind of market cap, you're giving away a really big piece of the company. So we're just going to explore the $680,000 this year, and wait for better times to make or better market prices to make a bigger impact on the property.
I think I kept calling it Volt Power there at the beginning. I did mean Volt Carbon.
Yeah.
I know it's Volt Carbon.
Right. Volt Carbon Technologies.
Right.
Yeah.
Why would they spend $680,000 in your project and then give you $1.5 million to only really get 5% of the project, and then some shares, which, well, not some shares, because they're getting a decent chunk of the company, but still they're giving you way more money than what the entire company is valued at on the stock exchange.
Yeah, well, right. If you compare 10.3 cents to the current market price of 5, it is a premium. Now, when we cut the deal, it was a little closer. Maybe it was 8 or 9 cents. I forget. But the reason, one of the reasons they wanted to do the deal, and I don't want to speak for them, but this would be a good question for them. But I mean, I know why they did it. They're a battery manufacturer as well as a graphite processor. So they've moved their business away from exploration, and they show their battery material and manufacture batteries to manufacturers. And those manufacturers, when they see a battery they like or anode material they like, the first question they ask is, okay, where are you going to get your graphite? So they needed a deep relationship with somebody further upstream in the supply chain. Mm-hmm. And that was us. So, the answer can be, we're going to get it from ePower Resources.
Right. I am going to want to talk about the graphite market somewhat later on in the conversation, because I don't know too much about it, and I want to understand what those producers are wanting here. Just to go back to the financing situation, though, because that's always interesting to me as a junior who could be like, you're going to need big exploration programs to get to a decent resource and stuff like that. Where do you get the money from is an interesting part, and I want to go a little bit deeper on that. Will Turgeon be part of that financing? Can Turgeon be part of that financing strategy, given that you couldn't find anything economic on it for now? Can you option it? Can you sell it? Can you do something with it?
Yeah. I mean, our objective with Turgeon really is not to spend money ourselves on the property anymore. The objective really is to find a partner who would take it on. It is a great property, but really a base metals and gold target rather than anything else. So there was some graphite there, but it's just not the type of, I guess, geological environment that is likely at all to host a graphite, or a world-class graphite deposit. So really, it's important for its base metals and gold exploration potential, and it sits directly between the Casa Berardi mine held by Hecla and the Detour gold mine, which is now Agnico Eagle. And we actually border the Detour gold mine property on the Quebec side. And just to the north of us also is Probe Metals, who just had a very long polymetallic intercept. I believe it's about 2.5 kilometers from our property, but it was 345 meters of nice polymetallic intercept. So it sits in, you could call it one of the hotter gold regions in Canada at the moment. Newfoundland is probably number one, but that part of Quebec where you also have Wallbridge is probably number two at the moment. So we'd like a partner to take the property on, either through outright sale, where we might keep equity in their company, or an NSR or something like that, let them run with it and, maintain a little upside as well. And, possibly get some cash right up front too, and let them run with it, because it's the type of property, because there's a lot of overburden on it. Boots on the ground doesn't help a whole lot. So there is a lot of data on the property, but yeah, the boots on the ground doesn't help. So in some ways you prospect with a drill. And so whoever does it, it's in a great neighborhood, but whoever does it is going to need at least reasonably deep pockets. So we're looking for somebody who could take it on and run with it while leaving us some upside.
Are you chasing that actively? Like, are you going out there and putting for sale signs on it, or looking for partners, or is that something you just kind of wait for?
Yeah, it's probably a little more discreet than that, but we do tell people about it all the time, and are talking with people who've, I guess, been sniffing around. A few months ago, you probably didn't see anybody looking for properties, but now you do. So we haven't cut a deal yet, but it looks a whole lot more likely now than it did 6 months ago.
Right. Okay. Let me ask, maybe it's a simple question, but potentially it's not an impossible, but it's a difficult question to answer here. But if I were to buy shares today, when and how can I hope to make money? And how much money do you think you'll have to raise and spend in that process?
Well, that's a good question. Like, there are only the universe of graphite companies in North America, and I'm talking upstream graphite companies here. There are only about maybe 10 companies, and I haven't counted them all up, but it's something like 10, and 10 graphite properties in North America worth looking at if you're a manufacturer who's desperately going to need graphite. And if you want to make batteries, you desperately need graphite, because graphite is almost the entire anode side of the battery. A battery has the anode side and the cathode side. Cathode is the metals, which is, also known as the positive side of a battery. Graphite forms about 95% of the anode side, the negative side. And the metals on the cathode side sometimes change. Different batteries have different compositions of metals, but the other side is always the same. It's graphite with a little bit of silicon added to it. And that's it. That's a constant. So if you want to make batteries, you need graphite. And all this battery manufacturing capacity is being erected all over North America, and the same is going on in Europe. And you've got a lot of politically driven capital as well, being almost forced into the sector. And you look at, all right, what can we do around electrifying the planet? Well, we can build a factory. It takes 4 years, or we can build a mine. It takes 10. I've got an idea. Let's build a factory. So they all did. And everybody's building factories. And there hasn't been a whole lot of thought into where they're going to get the graphite to fuel those batteries. Like Benchmark Minerals Intelligence estimates by 2035, which is now 10 years and 6.5 months away, they're going to need more than 4 times the natural graphite production they have now in order to feed, every sector that uses graphite, and including the electric vehicle battery sector. So in North America, you've got maybe 10 graphite properties worth looking at if you're a manufacturer. And our Tetapisca project, I would say, is on that list. And manufacturers are going to have to secure graphite while it's still sitting in the ground, because there's just not enough above ground to go around. China produces about 75% of it, and they're a net importer. So it all really gets consumed in China. And you've got some production in Madagascar, Mozambique, and there's some in Brazil and India. Those top 5 together are about 93% of global production. So it's, and those, even if they're okay, they're quite far away, and where the Chinese are importing most of the East African graphite. So if you're building all these factories, you're going to need, a factory might be $5 billion. Like I think Honda just announced one in Ontario for $15 billion. And if you build a factory for $15 billion, what's another 200 million to make sure you have a graphite deposit that's going to be able to feed it? So we're in the unique position of, in the gold business, to draw a comparison to, the gold business, you prove up a resource and you hope that the majors buy you out. And the majors can, but they might say, my life is okay. I don't really need your gold deposit. And it just stays. But we know with graphite that they're going to need it. And what is another 200 million when you're spending 15 billion on a factory and you've got nothing to feed it? So the way we're looking at it is we're about 1 of 10 right now in the universe in North America. And, Europe's in the same boat. There's all this construction of manufacturing capacity, and there's very little graphite production in Europe. There's a little in Norway, which is less than 1% of global supply, and Baie-Comeau, near where our project sits is not that far from European ports, maybe 1 week sailing time. So we're in a geographic position to feed both markets. But if you're a manufacturer, you've got to nail down some graphite pretty much now. And we started the company for exactly this reason, because we knew they would have to do it. So it just happened for the very first time. People would say, when is it going to happen? When is it going to happen? And it happened for the first time in February. Nouveau Monde, just 2 weeks after acquiring the half of the deposit immediately adjacent to our property, the Ouatnon project from Mason Graphite, 2 weeks later, they announced equity investments of more than $150 million US from General Motors, Mitsui, and Panasonic. So that graphite for everybody else, plus the other project Nouveau Monde has in Western Quebec, those are off the table for everybody else. General Motors, Mitsui, and Panasonic have that locked down. So that was 2 of about the 10 projects in North America worth looking at, and there are 8 left. So, you've got Volkswagen in St. Thomas, Ontario, building what will be the largest building in Canada to produce 1 million batteries a year in 2028. And one single battery for an electric vehicle is somewhere between 50 and 100 kilos. So, and if you want to get 100 kilos of graphite, you need about, of anode material, you need about 200 kilos of graphite. Now there is synthetic and natural, but natural is much more cost effective, and we can go into that. Yeah, that's probably on your list of questions, but so there's a very small inventory of noteworthy graphite projects in North America. We're on that list, and they're all going to get taken out, and the continent needs probably another 40 just like it. So we don't need to spend a whole lot of money. What we've spent to date on exploration, I forget the numbers, but it's probably not quite $2 million. Maybe, it might be 1.5 or something like that on exploration. That was already enough and there was previous historical work done. That was already enough to put us on that map and in that universe. So, do we get a lot of value from proving up a resource, a massive resource, and spend, who knows how many millions of dollars to do it? A 43-101 and sit and wait. But we already know there's a lot of graphite there. We're kicking it on the ground. We don't really see the value in proving out a gigantic resource and waiting. It's already obvious this is a noteworthy graphite property. And so we don't really intend to spend a whole lot of money going forward. We got to keep the properties current, but with low equity prices, we sure won't, because we're still in that universe. And we don't really need to dress up a whole lot more to attract attention.
Right. When you say attract attention, that's maybe getting to my point here, to my question here, which was how and when am I going to make money on? So talk to me about the time wise, when would I make money on this if I bought it today, but also how I'd make money on it, because attracting attention, I suppose you're talking about a potential takeout. Being able to sell the project. So talk to me about that.
Yeah, well, when we started the company back in, late 2018, really started raising the money around January of 19. It was really just to secure some graphite in the ground, de-risk the project as much as possible and monetize it by, selling it to a manufacturer. And we could do this possibly with the Tetapisca property more than once, peel off a piece, sell that to someone, and then peel off another piece and sell that to someone as well. Now, with a market cap of 2 million, they might say it's just easier to buy the whole company. But so when do you make money? Well, we're at 5 cents now. Our valuation is slightly less than $2 million. As long as we can stay in the game, then, when do you make money? I think you can make a little money pretty soon. But if you're waiting for the big day, as I am, I don't think it's too far out, because, I intend to sell all my stock in the company in one day. And that's that day that it just goes. And if we're on that list of graphite properties that, they're all going to need, and they need 40 others like it that don't exist, at least not yet. So, when do you make money? I'm thinking, in 2 years, I'm sure everybody tells you this, we're gone. There is no more ePower. It's a subsidiary of something else. That's my guess. And, you've already got 2 of the 10 noteworthy properties off the table now. So that's that graphite spoken for. And usually, if you imagine, there's a hurricane coming and everybody wants to buy batteries, and they've got 100 batteries on the shelf. When you still have 100, they don't, all right, maybe I'll get some later. But when they're down to 60, then all right, let's get some batteries. And so I think the fact that the trend has begun means the trend will accelerate, and it won't take long to get to us, because there are only 10.
So when I watched an interview of yours that was from about 10 months ago or something like that, and I was under the impression that you had a different time horizon at the time to come out with a resource. I believe you mentioned May of this year or something like that. But what's happening? Why the slowdown, or is the strategy changing a little bit maybe here?
It has changed. And you know what we looked at, like, you know, when we first took on the property, it looks, you know, pretty clear this is quite possibly one or more world-class graphite deposits. And, you know, it's early to say that, but all signs are there. So, you know, our strategy was, all right, let's show we have a, you know, this goes back probably more than a year. Strategy was, let's prove up world-class graphite resource and wait, you know, which is really what everybody does. You know, there are companies also in the space that have proven up their resources, which I'd say are world-class, years and years ago, and they're still waiting for that big day. So you know, we figured we'd hit the other end first, meaning rather than show we've got this gigantic theoretical resource, you know, with hundreds of millions of capex that will result in an IRR of whatever percent. Let's just pick up some of this stuff, the graphite, and get it refined into like a 98% concentrate and put it in the hands of manufacturers. And because ultimately, who makes the decision? It's a guy in a lab coat who's, you know, working in battery development, who's going to say, all right, that's the right graphite. I need that. And then we can figure out how many tons precisely of it we have. You know, the other way is you've got all this theoretical tonnage, but the guy in the lab coat doesn't really know this is going to work. So we decided instead just to hit that side of it, really. And working with Volt Carbon, we're able to get our graphite in front of electric vehicle battery manufacturers, and they can run tests on it or whatever. And you know, if they want larger amounts, you know, from what they're telling us, they're willing to buy it. So we can go scrape some more of it, and you know, in a way, getting paid for exploration. And then, all right, we need to know that you've got you know, X number of tons or something like that. Then we could put some drill holes in, but by then they're already sold on the product. So the guy in the lab coat will say, let's keep following up with this. Now it might be better for them to just take it out earlier than that, but it's yeah. So we're, rather than, you know, dress up that gigantic theoretical resource, we're going after the people who need the stuff to put it in a battery.
So it's not at all like a typical junior company. If this was another metal, like if this was copper or whatever else that it might have been, it would have been way different, as far as I understand it.
Yes. And our strategy was the traditional strategy when we got started. It really was. And we just started to see things differently. And you know, and we saw the manufacturers kind of waking up to the issue and even making contact with us. And that wasn't happening, you know, 2 years ago, but it's happening now. And, you know, in many cases, they don't really always know the right questions to ask. They're not used to this problem. You know, you have the traditional manufacturers who are getting from regular automobiles into electric vehicle, the electric vehicle market, say like a Volkswagen or something like that. And then you have other companies that are funded, you know, really, that have come out of the blue in the last several years and didn't exist. And, you know, companies like Northvolt in Sweden, who are now building a big plant in Quebec. You know, that's one of those companies that got, I don't know what the number is, but something like 10 billion euros from Goldman Sachs and friends. And they've funded this gigantic company. And it was really started, you know, with nothing. And so there, some of the manufacturers are like that. So those people don't really have experience in hunting down raw materials. They're not readily available because they weren't hunting down anything before. And you have other companies like, you know, the Volkswagens of the world who know how to hunt down raw materials, but it's never been that hard. You know, we need more manganese. All right, next Thursday it'll be there. And but it's not like that anymore. And So yeah, the manufacturers, are beginning to, I guess, wake up to that reality, and yeah, are looking at mining as something that they're just going to have to do, or work with a partner company to get it done.
Again, I do want to talk about all these things. I'm wondering also how needed really is natural graphite. So I hope we'll touch upon them later on as well.
Yeah.
I'm just taking some notes here as I go, because I'm then wondering about the actual work that you'll be doing this year in the meantime. And as I mentioned, as far as I could take off from your news release, you're going to be doing some bushwalking this year, basically some chip sampling,
Yep.
some bulk sampling too, which you think is going to give you eventually enough product to sell to let them test the graphite, basically. But you already have geophysics on the project, so you know that mineralization correlates directly with high conductivity from the EM that you did before. So why is this? Why is the chip sampling? I maybe get the bulk sampling, but why is the chip sampling needed here?
Well, actually, we've done a little chip sampling, but really what we're doing is, and the chip sampling is on parts of the property we've never visited before. So that maybe the more advanced exploration going on is bulk sampling. And so what we did was we just chose 4 different target areas where we know there's some beautiful graphite right there on the ground. You scrape away a few centimeters of overburden, and there it is. You're looking at the black stuff. So we just took about like a 1.1 metric ton sample collectively from 4 of those different target areas. We're sending it to Volt Carbon Technologies to process it into like a 98% purity concentrate. So that can be then shown to manufacturers. That was really priority number 1 of the program this year. We're also bringing out a man-portable drill. So where we find some beautiful graphite on the ground and scoop some away to take to Volt Carbon, we can also take the man-portable drill, a low-cost way of doing a short drill hole, and maybe know that, hey, this goes on for another 7 meters or something like that. And if you can do 7 meters over a little bit of distance, that's you're getting some quantity there. And so we've got a man portable drill out there as well. And we want to take a bulk sample amounting a total bulk sample amounting to about 30 tons from maybe 5 different target areas on the property. And what we did was to get that 1 ton right away, so that very fast it can get into the hands of manufacturers who are waiting for it. The other 30, or let's call it 29, would be so that there's an inventory of processable graphite, or I guess we call it, that can be turned into the 98% concentrate and given to those battery manufacturers. So yeah, rather than just drill, why drill, when you're looking at it? Drilling could come later when we're trying to see exactly how far down this goes, or how far in a certain direction. But for the moment, let's get the stuff, show that it works, put it in the right hands, and have an inventory there available for sampling and even sales.
You mentioned 5 areas or 5 targets here for that work. I believe you mentioned it somewhere in the news release as well. Where are those targets on the package? Where exactly are you going?
Yeah, well, there's an area called the Captain Cosmos area. Some of these areas were named before we got there, but the Captain Cosmos area, is a place where we drilled 5.15 meters for 24% graphite, and just with a man portable last year. And we went over there and scoured the earth. We've got some beautiful pictures of it, revealing the black stuff, and pulled up, 250 or 300 kilos, which is now on the way to Volt Carbon. There's another area on the extreme west of the property, which we call the prospector showing. We bought the first little piece of this property from a group of 6 prospectors, and they had the property based on this one particular showing that was pretty fantastic. And so we went and scoured that and took a representative sample to send to Volt Carbon. And then there are two other showings called Graphy West, which I guess would be in the southern and center area of the property. So yeah, and those are on the way also to Volt Carbon Technologies.
Yeah. Okay. So when do you think you're gonna have some of these? You say you're in the property now. Basically, I mean,
Yeah.
you have people walking the bush now. How long is it gonna
Yeah.
take them to go through all 5 of the targets?
Well, the first shift just concluded, and so what they're doing is working, some time on, time off throughout the summer. So first shift just concluded. The major objectives there, we're getting that 1 ton representative sample from 4 different target areas, and also starting to prospect the northern end of the property, which we had never visited before. So we've only really been out there a few days, and there will be some chip sampling, or there has been some chip sampling up there. I think they took 37 samples thus far, but that, in with geophysics, that northern area lights up pretty red hot. But this is our first visit ever to the area. So they're walking the bush. They have a beat mat, walking over the conductors and looking for places where you can expose the graphite, in like a meter of digging maybe, and or if you just get outcrop and get lucky. So yeah, they're working on that part of the property. So the whole program will be going on through probably late September, but it'll be on periods and off periods in there.
Right. And then based on that, how are we going to see the news release?
I think the first news release will probably be the results of the processing of the 1 ton sample that we just sent to Volt Carbon. And we could even do a news release saying we sent it there, but I just spoiled the surprise. And so, yeah, we'd probably publish first. That would probably be ready first, the results of that. And also samples were taken out to also send to like an ALS, a lab to get carbon analysis done and looking for other elements there too, especially if there were deleterious elements.
Okay, so that would have been one of my next questions. You don't know yet if there's any arsenic, mercury, or something else?
Well, we've never seen anything important enough to worry about, but we still check when we're digging up a new target area. We still check. So yeah, thus far, no.
Okay. Is it all permitted now? You said you're going to part of the property that you haven't been before. Are you dealing with different communities around the property? How's all that?
Yeah, well, this property is located in a kind of unique place. It's the infrastructure to arrive at the property is fantastic. It's about a 3.5 or 3 hour, 15-minute drive from Baie-Comeau, Quebec. All but the last 60 kilometers are on a major highway. And then you get on class 1 logging roads for about 60 kilometers. And those class 1 logging roads are the ones, designed to handle big logging trucks. So the timber industry and the hydroelectric power industry keep this place well roaded, I guess we could call it. You can drive almost anywhere, and there's nobody who lives there, which is nice too. So you don't have to worry about waking up the neighbors. And at the same time, because there's a large hydroelectric dam there, there's a hotel, which you could call more like a camp. And so you can actually stay in a place, that it's a service station basically with a hotel component to it. So it has everything you need. At the same time, you're not going to disturb anybody. There is a First Nation group we work with there. It's on their land, but it's one group, and we've never had any issues. Everything, so far so good. And yeah, we just had a meeting with them, I think about a week ago, and so yeah, all appears to be good. The permitting for the bulk sample's been submitted, but it's not finished yet, or it's not granted yet. But all the boxes are checked, so we're expecting that soon. So what we're doing now we didn't need a permit for. So, yeah, that's that's the situation about the infrastructure and neighbors in the area.
Okay. You're not making any new roads or any major changes to the area, I don't assume, to do that work?
No, no. You know, if you cut down a few trees, you basically compensate Quebec for the trees that the lumber company won't be able to cut. You know, so that's just part of the permitting process. So yeah, but there's almost no real impact. You know, it's you're just you're never very far from what is already an established road of some kind.
Yeah. Okay. Sure. That makes sense. And then after that's done, so Volt Carbon is basically paying for all that work.
Yeah.
Well, is the $680,000 that they have to spend this year, is that going to be enough for all that work?
Yes, it will be.
Yeah.
It
Yeah.
will
Okay.
be.
So they're paying for all that work. Just checking that they're paying for all that work. And then the money that you have right now is what, covering G&A for you?
It is. Yep.
Okay. For how long? What's the runway?
Yeah. Yeah, we don't have much cash at the moment. You know, we've got $100,000. We're expecting some more small payments from you know, like government tax refunds and stuff like that. So we're just keeping it tight on G&A, and you know, we don't want to raise funds, at least probably till the fundraising season begins again in September. We'll have to, but the exploration is covered. The budget is that 680 really. So that's covered. And so we don't really have to raise any money now. We just need to keep it tight, not do anything crazy, and wait it out until September, and hopefully higher equity prices.
But the money that you have right now is going to get you through July, August, and September, 3 months?
Yeah, we're not worried about that. Yes.
Well, because you said you have $100,000, and when I checked your numbers from the last 3 months, it showed up as $100,000 in G&A per month. So if you have
Yeah,
$100,000, you only have a month of runway.
Were you looking at a quarter, or were you looking at a year, or?
I was looking at quarter, but then averaged it out per month. So
Okay, yeah, divided by 3, I guess. Yeah. I don't really know, but the you know, I would say our burn rate is 45. And
okay,
that may have been caused by expenses being pushed forward into that particular quarter. I don't know, but that seems high. And yeah, I'm confident we can last the summer for sure without yet being in the capital markets till early September.
okay, good. Yeah, it did seem high to me too. So that's something I did want to ask you about as well. Let me just
Yep.
pull it up so I can make sure I'm not seeing it wrong. Yeah, well, so you have, March 31st, 2024, 282,553 is what you spent for the quarter. There's no depreciation or anything on it. There's no share-based compensation. Yeah, well, it comes down to a little under, so 282 divided by 3, it's a little under 100 grand a month is what it came down
Okay.
to.
Yeah.
Yeah.
I'm not sure what would have caused that. Maybe we paid a big legal bill or something. I don't really know.
But because
That
for the
seems high.
6 months ending in March 31st, so that'd be Q1 of 2024 and Q4 of last year, it was 640.
Yeah.
So it's a little over 100
Okay.
and 100 and something $1,000 per month. So that's why I asked about the runway. But okay, if you're
Yeah.
saying you're trying to get it to 40 now, you're trying to go through the summer without having to raise.
Yeah. 45. Yeah.
Okay.
45.
Good.
And we're expecting some additional small payments from the government, like QST refunds and stuff like that.
Yeah, that's what I mentioned, that the majority of your current assets were made up by those receivables. So you had $206,000 in account receivables. You haven't gotten that yet?
Accounts receivable.
No,
Trying
100.
to think of what accounts receivable would be.
Yeah, well, it's receivables. That's probably what you're receiving from the government here.
Oh, okay. It could be. Yes, that's what it would be. Yes. Yeah, we
Goods and
probably received
services
some of
tax
that.
receivables. Yeah, so
Yeah, that's what. Yeah. Okay. That we probably received most of that already.
Okay. Okay, good.
Yeah.
Good. You know, James, you're giving me a good idea of what you want to get done through the summer and where you want to be headed. So thank you for that overview. And I think a little bit of a switch here, maybe in the conversation briefly, because I know you must be tired of looking at my face already. But maybe a switch of focus here, as far as I understand it, and I know as much about graphite as my chair does, given that we share the same intellectual capacity on a good day. But as far as I know, not all graphite is created equal. And so, as you mentioned, especially when
Right.
you want to make batteries or other high performance technologies or consumer product or whatever in the end. So, how do I know that your graphite is going to be actually good enough? Because I know that there's a difference in flakes and all these things. So, how do I know?
Yeah. Yeah. Well, yeah. Flake size is a one of the better indicators of quality. There are two types of graphite, basically: amorphous graphite and flake graphite. And amorphous graphite is what you're writing with when you write with a pencil. And amorphous has the character more of a oily powder. If you pick it up from the ground and put it in your hands and your fingers, it'll stain your fingers and it feels oily. And that is actually also used in electric vehicle batteries, but doesn't command a very high price. It's like the low end of graphite. Then there's also flake graphite, which has more the character of a rock. And if you're looking at large flake graphite, sometimes the flakes are big enough that you can see them with the naked eye. They can be like 1 to 4 millimeters. And the rock can look like a pile of Frisbees stacked up. And I have some good photos from Tetapisca that were just taken last week that I can show you like that. It's literally a stack. It looks like a stack of Frisbees. And that is flake graphite. And flake graphite is the more desirable type of graphite for not just batteries, but lots of technological applications. So the better, and every graphite deposit will have what's called a flake size distribution. So some of the graphite will be amorphous, some will be fine flake, and then some will be much larger flake. And there's going to be a mix. And the flake size that's typical in this region can probably be exemplified by that of the Ouatnon deposit, now held by Nouveau Monde. And they've done extensive studies. Our graphite, looking at everything, it appears to be quite similar to theirs. And when you pick it up off the ground, you can look at it and say, okay, that's the right stuff. That's flake graphite. My rock looks like a pile of Frisbees. And so you can tell with the naked eye what you're looking at for the most part. And the most often used, used in the highest proportion in batteries, is fine flake graphite, which is actually what you could call the worst of the best. And if you want better performance, you would want to graduate further up the flake scale, really. And and then you also have synthetic graphite, but maybe that's under another heading. But the batteries are the largest component of the natural side of the battery is fine flake graphite of typical batteries today.
And so in your case, is there a difference in the purity across the package? Is it more concentrated zones or something like that? And I understand I look silly here, but I'm trying to understand what's happening.
No worries. And a few years ago, I didn't really know anything about graphite either. If you sorry, could you say that question again, just to make sure I'm answering
in terms
the right
of
question?
purities? I know sometimes the purity of the metal matters for the battery. So does it matter for graphite? And is it different for you across a LAN package, or is it all one purity?
Well, I mean, purity, as it sits in the ground, the purity is low because you could call it graphite ore, and it's maybe it's 15% graphite or something like that. But when you extract, when we bring it to Volt Carbon, we get about a 98% concentrate. So battery grade typically would be more like 99.65 or something like that, to put in battery anode material. So there is purification required to put it in, at least as technology stands right now.
Okay. So,
But yeah, at least for price, the flake size of the graphite is the biggest or really the only determinant.
okay, so the fact that your purity is lower than 99.6 doesn't matter, or like?
Well, the 98 is it's just an easy way to get them a concentrate, and they can purify it to a higher level if they decide they need to. And they might not, our graphite might be okay being 98% pure for anode material. We don't really know, but typically anode material might be 99.65 or somewhere in that range.
Okay. This is natural graphite that we're talking about, but isn't it mostly synthetic graphite that is already used in the batteries? Because I always kind of understood that it's just easier to do that, and that's one of the reasons why I haven't really paid too much attention to graphite.
Yeah. Well, synthetic graphite is about half the graphite used in batteries. And I'll just, it might be good to explain what synthetic graphite is. Like, graphite is carbon based. So as it's carbon based, it's not really a commodity. All graphite is not created equal, as you said, and it's different. Just as with diamonds, which are carbon based as well, or petroleum. It's carbon based. You have different types of petroleum, and coal as well. So not being a commodity and not being all the same, makes it a little bit different than everything else. And so tell me, what question am I answering now? I'm sorry.
I was just you were talking about the difference between synthetic graphite.
Yes, sorry. It's carbon based, so it's all different. And so because it's carbon based, if you have something else that is made of carbon, you can make it into graphite. And the way you do that, there are two, I guess, starting ingredients to make synthetic graphite. One is petroleum coke, which is ironically a byproduct of oil refineries. So if you want to make synthetic graphite, you need oil refineries. And you take that carbon-based material and you apply extreme heat and pressure to it, and you can turn it into graphite. And the same goes for coal tar, which is another fossil fuel. So you can take basically fossil fuels and apply extreme heat and pressure to them and turn them into synthetic graphite. But natural graphite, and graphite begins because it's carbon, it begins as life forms. It's like leaves and bushes and trees. And those were really sediment on a somewhat flat surface and accumulated and eventually got, swallowed up and pressurized and heated to extremes. And that stuff became graphite. So nature has already cooked the graphite for us, and with natural graphite. But with synthetic, you're trying to replicate a metamorphic event in a lab by cooking it and pressurizing it. So you're taking petroleum coke, putting it in the oven, and cooking it at extreme temperatures under extreme pressure. And how much does that cost when one single battery has 50 to 100 kilos of it? That's a lot of cooking. And, when you've got like brownouts in Germany, how are we gonna do that? So I think the reason for synthetic being such a big portion of batteries is it was an emergency, really. Synthetic, depending on what you're doing to the graphite, will cost generally between 4 and 10 times what natural costs. But there just wasn't enough natural to go around. So we just need to make this battery. I don't care what it costs, all right, cook up some synthetic. put it in the oven and send it to us. All right, we'll do that. But there's not enough synthetic capacity either to keep up with demand. So would you really want to buy the graphite that's already being pressurized and cooked by nature? Or would you want to have to do all that work yourself and consume all those massive amounts of energy that go into create? And we're talking like 3,000 degrees Celsius. So, it's no joke when it comes to temperature. So like I've seen a synthetic graphite recipe, and it was cook the graphite or cook the petroleum coke for 2 months at 2,000 degrees Celsius. And then you're not done. There's more. Then you have to cook it for another month at 900. And I forget how they created the pressure, but there was energy involved. And all right, you finish that, and how many batteries can you make? When they each one needs 50 to 100 kilos. So, if they're looking to save energy on this whole thing, you need natural graphite. And if you want to make electric vehicles affordable, you need natural graphite. And really, just if you want to have enough graphite, you need graphite, because there's not enough synthetic capacity either to make up the demand, make up for the demand caused by the growth in the EV industry.
But then to make the claim that natural graphite is cheaper, you would have to know the production cost of natural graphite. So you're going to have to know the grade as well. So in your case, the grade would have to be pretty high, like 20 to 30% in order for the OPEX to make sense and it be lower than synthetic.
Well, actually, do you know what the typical grade for a graphite mine globally is? Somewhere between 2% and 7% grade. So the graphite district where we are is what is known as the highest grade known graphite district in North America, and maybe Europe as well. So the grades here are much higher than they are in many other areas considered graphite districts.
So in your case, do you have an idea of what the OPEX might be? I mean, have you guys done any back of the envelope calculations?
Well, I mean, one barometer for looking at that would be, we could look at the feasibility study that Mason Graphite did on the deposit next to us before Vaumont took it. It's and I don't remember the numbers, but we're kind of looking at it a different way. And if you've just built the factory, we know we need graphite to produce any batteries in this multi-billion-dollar factory we just built. We don't really have to make any money mining graphite and bringing it to our factory. We just need to make sure we can get it, or we've lost the 5, 10, or 15 billion. Their study said absolutely it could be. Even at the prices, I forget what year they did it, but they did it probably 8 years ago or something like that, that it can be mined profitably. So, I mean, here's a back of the envelope calculation. If we assume $2,300 per ton and costs of roughly half that, I'm doing a whole lot of guesswork there. The 2,300 is based on maybe a typical flake size distribution in the region. And, if you put that, if you're getting $2,300 a ton, maybe your production cost is about half that. But I'm going on memory there, and it's probably from reading the Mason Graphite study they did on that. But it's been a while.
Yeah. So in the end, it's going to come down to grade free. Like, you have to be able to make this natural graphite cheaper than synthetic graphite for it to make sense.
I'm not even sure you need to do that. You just need to be able to get graphite. Synthetic and natural are producing at full speed ahead, and they're going to need both, because there's expected. As for battery composition, flake is expected to grow as a percentage of the battery, or not just flake, but natural graphite. is expected to grow as a percentage of the battery. But synthetic demand is also supposed to grow a whole lot as well. And I think it was twice in 10 years. So there's not enough synthetic or natural to go around. They're both needed. And natural is a whole lot cheaper. And if you want to stick with the green theme, really, you better be using natural because it's a whole lot less cooking than making synthetic. And they're also trying to, they say, make electric vehicles affordable for everybody. And if you've got, 80 kilos of very expensive graphite there in the battery, that's going to affect the cost of the vehicle.
Yeah. Yeah. And so do you foresee a world in which we stay on kind of the same ratio of synthetic natural, or do you think that over time synthetic is kind of going to die off?
Well, I think there'll always be synthetic there. You can make a material exactly to your specifications through trial and error that works for you. So you can kind of make a super graphite with synthetic. So it will always be, at least I think it will always be, an ingredient in electric vehicle batteries. And you need more synthetic graphite production. But natural, because there just wasn't enough natural to go around, natural will grow as a percentage of the battery, as we now know there is natural to go around. If the known projects that are that are substantial actually go into production. So yeah, I think the composition of the battery will go toward natural, but never eliminate synthetic. And both sectors, or natural and synthetic, are going to have to grow and grow a lot.
But so there's no, it's not that synthetic graphite is higher quality or just automatically higher purity or something like that.
Well, you can make what you could call it a super graphite. Like if you get the right recipe or you make the right recipe, you can make your graphite into something that works very well in batteries. But can you afford to make the entire battery out of that? And can someone afford to buy it? Probably not. And so natural, when you add synthetic that's specifically crafted to help that battery, you can improve the workability of the battery. So synthetic is here to stay for sure. And through that cooking and pressurization, you can make it a super graphite if you get the right, if you can do it with the right recipe and keep the cost of doing that, at least reasonably low. And you can add that to natural graphite to enhance it. And then you don't have it's kind of like, gold is a substitute for many metals, but you don't want to use it for something that's just regular. Do I want to use it for a pole, to sit out, like a fence pole? You could make a fence pole out of gold, but it's not a great idea economically. So you would use something else. It's kind of like a comparison between that and natural graphite.
Are you familiar with Sierra Resources?
Yes, in Mozambique. Yeah.
Yes. I'm not sure what kind of grades they're running. They're like 60%. I'm trying to look through their website. I think it's 16%.
Actually, I think it was 7. I think it's 6 or 7. 6, high 6s maybe.
Well, it says 110 million tons at 16%, so 16 TGC.
Okay. Yeah.
And then
okay, that's total graphitic carbon. Yeah. Okay.
Is that different than because you measure?
It is, but it's not enough to really be worth talking about. It's virtually the same, I think.
Because they struggle to make money at a certain point. This is not a low graphite. Yep. This is not a low graphite project. So for you to be as convinced in what you have going on, you got to be doubling that grade, basically.
I'm glad you brought that up. Their graphite is 86% fines. So meaning fine graphite. So they compete directly really with Chinese mines. So it doesn't have very much of that great flake size that you see in the Tetapisca region. So yeah, that's a good point. The grades are good. But it's 86% fines. So, and it's the type of graphite mine that can only work in a low cost area, because it's almost entirely, fines rather than coarse grain graphite.
Okay, so with the grades that you've seen so far, if you were to turn on the key tomorrow and magic a mine out of nothing, just, I don't know, magic wand, do you think you'd be operationally profitable?
Yeah, I think we would be.
So you don't need the graphite price to go up a lot from here.
Well, I think the graphite price will go up a lot from here. But if we were to build, if everything just happened overnight, we had a defined resource in the ground of with a good flake size distribution, which is quite typical here. I think you could run a profitable mine, and Mason's study on the Oatnon project said that you could. Now that data is about 8 years old, so have to compare prices now to 8 years ago. Like prices now of graphite are kind of low. They're probably down 35% in maybe 40 in about a year. I think they've just started to come up a little bit again, but they probably hit a low a month or two ago. And it's a strange situation. It looks like the calm before the storm, really.
Good. James, I've already not been too respectful of your time. I just realized that now when I looked at my clock, because it's already been more than an hour. But thank you though for that graphite overview. It is it's just a different world that I haven't paid too much attention to. But I'd be happy to keep getting updates on this. It seems like you have something interesting on your hands. I'll stop here. I might have more questions later down the road. But thank you so much for this overview. Is there anything that I'm forgetting to ask you that you came here hoping to talk about?
No, I think I think that covers it. But if just to leave viewers with, one last note, we've got a very low market cap, a tight share structure of 39.4 million shares. We know where probably 33 million of those shares are, because remember, we were a private company until, 16 months ago. And and we're on that short list of about 10 noteworthy graphite projects in all North America. And the continent probably needs 50.
You just said tight share structure. What's the split of who owns one again?
The split how?
The split of who owns one, like management owns one, and then
It's management owns maybe 14%.
14.
Yeah. And like I own 6%. I think I'm the fourth largest shareholder, maybe third, but I think fourth. And but not just that, we also have a core of shareholders who supported us from the early days as a private company. So we were funding, or you could say they were funding, a private exploration company from January of 2019 until we went public in January of 23. So the day we went public, we knew where every single share was. And those are people who've been supporting us, for the most part since the very beginning. And then after we went public, we did subsequent placements, and some of those same people supported us in those. So, we know where probably 33 million of those 39 million shares are.
Got it. Okay, good. James, thanks so much for sitting down with me today. This was fun.
Okay, great. Thanks, Antonio. Thanks, everybody, for watching.